On Drinks and Mics Season 2, some guests came to talk. Samson Esemuede came to break things down.
We have this mad system where 36 commissioners of finance, we sit down in their house all month, and then one Wednesday, or what day is FAC again? One Monday, they'll go to Abuja, they will sign paper, they will collect money. Zero accountability. When you are in Borno, and Borno may be on fire, and half of your country, state, is run by Boko Haram, and you cannot make any single money, but at the end of the month, money will still enter your account. What is the point? You might as well, there are governors in this country that spend more time in Abuja than they spend in their own state.
From the markets to the economy, from investing to the Naira, Samson brought the kind of perspective that made everyone pause, think, and sometimes laugh. Sharp takes.
So like I often, like Voltaire would say, those who can make you believe absurdities can make you commit atrocities. Right?
Clear explanations, no unnecessary grammar, just real insights from a man who truly understands how money moves.
In the oil and gas sector, there is already evidence that an investment cycle is kicking off.
On this season, the Oracle gave us some of the most memorable moments on Drinks and Mics. He challenged assumptions, he explained the numbers, he connected the dots. And in true Drinks and Mics fashion, he did it with honesty, humor, and a drink on the table.
The market needs to believe that the short-term interest rate has anchored inflation expectation to reprice the entire curve and reprice equity assets.
So before we move forward, let's take a look at some of the best moments from Samson Esemuede on Drinks and Mics Season 2. Grab a drink, pull up a seat. This is the best of Samson Esemuede.
We have Sam the Oracle back in the house. He's not been christened the Oracle by you guys, so he's the Oracle. Yeah, Sam is wondering why you guys got him the Oracle.
I know, I'm actually quite scared.
Well, he's the Oracle, of course.
I think I was having this conversation with my wife. I'm like, I think Drinks and Mike has been good for the business. Whether it's been good for me, I'm not sure, because I get ambushed all the time.
I want to talk about your views.
Yeah, and the problem is, like, I mean, I don't want, like, I walk into a place and somebody walks up to me and was like,
you want to be anonymous, right?
And I've always lived my life completely under the radar. So it's like, it's just brought me to the surface. And to be fair, it's been good
great,
from a business perspective, because like a lot of people, last week I did a presentation at the Metropolitan Club, for example.
Wow.
Right. Wow. Which was like really, and clearly that came from Drinks and Mike.
Yeah.
Because no one knows my views outside of this, right?
Yeah.
So it's good, presented to some serious people, heavy hitters about my outlook and macro. So that was quite decent. So professionally it's been great. But personally I can't hide.
So Sam, what's your view? What's going on globally? Global macros.
Oh, that's one of the, especially the US, right? Something that I've been trying to wrap my head around, and I'll put some context around it, right? So the US economy has slowed, right? We've gone from basically creating 120, 130,000 jobs a month to creating about 50,000 jobs a month, right? However, unemployment rate hasn't gone up, largely because labor supply has been constrained as a result of the immigration crackdown. And when you look at tariff revenues that are coming in, and in my mind, tariffs are basically direct taxes on US consumers and US businesses.
Which they don't seem to know, though.
Kind of looks like I think they will soon find out. I think it's becoming quite clear. So you and the way I see it, right, the US economy is largely two things in my mind. It's the service economy, which is over 70% of the economy, right? And then it's government spending, right? Business spending is quite small. It's just now that AI capex is accelerating, so you might see the positive delta there. So when unemployment is declining at the rate that it is, right, it affects the service economy. So I think you'll see that deceleration. And then obviously with the tax, the fiscal impulse becomes negative. So when you add those two together, right, that argues for a slowdown in the US. However, because of the tariffs, inflation expectation is accelerating. So if you look 3 years out or 2 years inflation swaps, right, they are trending 2.5 to 3%. So that doesn't call for an aggressive rate cutting cycle, which means that if the US becomes too aggressive in rate cut, it will be seen as losing credibility. So that confuses me a lot. So while you have a slowing economy, I think Q4 and Q1 are probably going to be, in my opinion, quite bad from a data perspective in the US. Justifies a rate cutting cycle, but the rate cutting cycle might not be as aggressive as people think because of the impact it's going to have on inflation. I don't know much about shares, so it's very difficult for me to comment. Oftentimes when I see the banning, right, I'm always very nervous because it doesn't, when you want to develop local
You don't
capacity,
start by buying.
right? It's not just that. You have to have an industrial plan,
Exactly.
right? I have not seen a well-articulated industrial plan in Nigeria yet, right? So if there are one of the blemishes I would paste on the records of this government is that we've done a lot on macro, but like in order for you to actually
the core economic plan itself.
I haven't seen that, right? It hasn't, or at least it hasn't been articulated in a way that we can buy into it, right? I'm hoping that comes. But anytime there is significant global change, it presents an opportunity, right? But you have to be proactive to figure out how to take advantage of that opportunity, because I think export-led growth, right, to Western economies, like which has basically propelled the Southeast Asian countries and China in its developmental journey, I think that window is getting closed, right? So you need to really think about new growth drivers, right? And that is why you need to think about integrated markets. That's why you need to think about exporting into other EMs. That's why we need to be a lot more proactive in terms of how we ensure that we have the base, right, to support a new growth structure. Because the idea of basically making cheap things and taking advantage of cheap labor in Africa and exporting it into Western markets, I think that window, at least in the short term, is narrowing.
Religion allows you to believe
Make
in
you
what
righteous.
I call non-objective realities. So those are realities that are not necessarily true, but a lot of people believe it, so it comes to life.
Let's put it like
right?
this. There's no telling what a man will do when God tells him to do
it. So like I often, like Voltaire would say, those who can make you believe absurdities can make you commit atrocities, right? I think...
Wow, you're quoting Voltaire. The religious people will not like him.
But the point is, like, religion allows you, right, to basically at scale aggregate and drive people towards a certain cause, right? That can be a force for good and that can be a force for evil.
That's how we're colonized anyway. So
yes, it is clothed in religious garbage, but the reality is I do think it's resource control. Because you keep asking yourself, these bandits, they look quite sophisticated to the point where
they're well-resourced.
Governments
They're
are giving
well-resourced.
territories. These are not banditries. These are people that have been resourced.
Yes.
That some local governments in Katsina had to do a deal with the bandits. A peace deal. I mean, that is...
There are parts of Nigeria that are under the control of non-state actors.
I always struggle with building geopolitical risk into my investment process because it's a tail risk event.
Thanks for introducing me to a new client.
you're welcome. So you've been paid.
So I'm glad that I came.
So because I always struggle with it because because those are tail risk events, but I know that operating within the context of Nigeria means that your tails are fat, right? And you need to then you kind of have a narrow base of outcome. But the problem is you can't deploy, it's very difficult, and Nigeria doesn't give you the hedging tools, right, that allow you to manage tail risk effectively. We're a research-first organization, right? And deep research, ideas come after research. We don't chase ideas. We just chase understanding at a deep level. And the reason why we do that, I mean, I'm a chemist. My partner is an engineer. So we are not finance people. So a lot of how we think is basically engineering, science driven. Right? It's first principle. So yes, interest rate go up and inflation come down. We don't take it as a given. We have to map all the processes and the channels in terms of understanding. Because economic theory was created in an environment. And economic agents are, economics is not physics. In physics, an atom is an atom. Right? Gravity is gravity. Right? But economic agents changes behavior. So if you study a particular situation and you come up with rules, they may not apply because the agents have changed.
Exactly. True.
Location also matters as well.
Yeah.
How you
Culture
apply
matters.
those things.
Like,
Like,
emotions matter.
Yeah.
Like these are like people
Even
that
the time. Even the time.
matters.
The same
Like,
place, same community.
I like Sanusi. I think he was an okay central bank governor. I don't think he was excellent. But from a pure central bank perspective, I would explain. So the tools that Murphy abused and bastardized was created by Sanusi, right? And Sanusi knew how to use those tools to achieve his outcomes. Murphy abused them, right? And so for me, Sanusi started this concept, right, of the central bank being a developmental institution. He created this sort of dual mandate for a central bank. There's a reason why central banks usually are quasi-independent institutions that are focused on a core mandate of inflation targeting. And the reason why this is important is what Nigeria needs, in my mind, is non-inflationary growth, right? And non-inflationary growth will come from what I call supply-side factors. What Cardi B's job is to ensure that demand factors don't drive inflation out of whack so that we don't have inflationary pressure. Is the fiscal authority and the development authorities, and we have to create them, that will now be responsible for the supply side debottlenecking that ensures that growth comes in a way that it is not inflationary. You have a cancer patient. The cancer patient has tumors all over his body, right? And he gets rushed to the hospital, is like 20 minutes to death. Right? And you bring a skilled surgeon. The surgeon operated, took out all the cancers.
Exactly. Crisis management first.
Right? And took out all the cancers. And then all of a sudden we're like, you know what? You cancer guy that has just survived, go and run the Olympics.
Well, no, that's a far cry. That's a far cry.
So we are now in the process. So now that the cancer patient is stable, we will now say, okay, this guy needs nutrition. This guy needs to improve his muscle strength. This guy needs, and this is what I call, I've said this word a lot of times, we need to kickstart a growth investment cycle.
Yes.
Monetary policy is a blunt tool to drive economic growth, which is why I always say it is not Cardi B's job.
What is the sharper tool?
You know,
Fiscal policy.
Sorry. You know why?
So what Nigeria needs to create is the equivalent of BNDES in Brazil, the equivalent of KFW in Germany post World War II, the equivalent of the Blue House in South Korea.
I would agree with you, Sam.
That's what that is where I differ from you. I think what drives economic growth, right, is economic reality. Right?
How do you mean?
So what I mean by that is it was impossible, and we saw that despite the best efforts of Sanusi and despite the best and corrupt efforts of Murphy, right?
Allegedly.
Whatever. So we saw that despite their best effort, the banks didn't turn on the taps, and the reason is very simple. Point one is you were paying the banks to basically bet against the country. Number two, you had fixed income yields that was relatively high where they took no capital charge, and then you had an economy that just didn't have capital opportunities to deploy capital at scale into. As a bank manager, what do? You earn your, returns even got crushed. And you saw that in the numbers. Return ROEs went from like 30s for GTB to sub 20. And the bank still didn't learn. Because number one, the risk environment didn't make sense. They would rather just build their securities portfolio. That we need to understand that banks are very conservative institutions by nature because they are basically lending the deposits of people, right? So when you look at financing options that are available to people, banks should really be dealing with the mature end of the spectrum, unless they are like more like
like specialized, which is why countries like the US have different classes of banks and different types of banks. They have regional banks, they have community banks, and those banks are actually doing more risky stuff because they know the community, they're embedded in those communities. We need this risk-taking capital, right? That helps de-risk opportunities that then allow banks to then lend on top of. So I am not surprised with Lanre, right, that an entity like MBO, which basically have raised money from LPs, right, higher risk capital, will do the analysis and take that risk. And post that, and for me, that's the natural evolution of how these businesses should grow. Right? You cannot want to go and export cashew and you've only exported 10 tons of cashew or 20 tons of cashew, and you go to GT and you expect them to listen to you. Of course they will.
Which is
See, the way I see Cardi B evolving, right? I think he wants to keep positive interest rates for as long as possible.
Yeah.
Right?
That's for sure.
And I think for him, he probably wants to be 400-500 basis points above where he thinks structural inflation is. Inflation is. The big debate in my office at the moment is, where do we think structural inflation is? Some people in my team thinks it's sub 10, right? Because the argument has really been that outside of this monetary exchange rate induced pressure, right? What are the structural elements that has changed in Nigeria that will significantly push inflation higher? And we haven't been able to have a credible answer to that question, right? So we really
As in, what are the shocks?
Yeah, so we've had shocks, but the shocks have come from exchange rate and have come from money supply growth predominantly.
So you're asking anything else outside of
It's
that?
outside, because the question is, before the last 2-3 years, we had inflation around the 13 to 16% range, roughly. Right? And even at that point, we were a decent chunk of that inflation was driven by exchange rate instability and money supply growth. Because so you have to really look at what the inflationary dynamics was in Nigeria pre the Murphy era, right? And then you then look at that data and then say, okay, what are the structural shifts in inflation, right? What are the challenges in agricultural productivity that drives food inflation, right? What are the infrastructure bottlenecks? So is the infrastructure completion index better today than it was before? I mean, it's not an exact science, but what we are trying to figure out is, in a normalized environment, right? Because a big chunk of, obviously, inflation will grow by your population, right? And then obviously your productive capacity. So obviously we don't have enough productive capacity, but a lot of productive capacity are getting restarted. So we don't have enough productive capacity. So there's a structural element of inflation that we think is somewhere between 8 to 12%, right? Wherever some people are lower, some people are higher. My sense is Cardi B wants us to go towards that number. And then there's going to be a rapid rate cut, right? From 26% to probably the 16 to 17. No, I agree with you that we need a private sector-led, public facilitated developmental initiative.
You have just said it. I'm afraid.
I agree. But it cannot be run by the CBN.
So how do we
all agree?
I agree.
I'm not saying that
my own recommendation is that we should create an entirely new institution that basically is overseen by a combination of the Ministry of Finance and the CBN and maybe the Ministry of Finance, right? Largely Ministry of Finance.
We actually have a lot of them. BOI,
all of them. So
That's
the question
all
is,
created.
you have to consolidate them into a monster institution that can mobilize and is driven through a private sector lens that can mobilize capital. Nigeria needs hundreds of billions of capital.
Yes, agreed.
And you need the institutions that have the credit rating to be able to mobilize both domestic and international capital to be able to achieve long-term developmental priorities.
This is just my thing. This is just my thing.
Do that.
No. This is just
I mean, I would imagine all of these institutions that you mentioned
all under
should all be under the Ministry of Finance.
Why should it be?
They should be consolidated.
Why should it be the government
They
doing
should be
this?
strengthened. Government has to set the strategic direction.
How is it through tax cuts? Because
so it's a combination of different tools, right?
So it's a combination of government tools will either be tax cuts,
no, so
direct injection of capital.
So government can identify, right? Government can identify priority sectors
right?
Okay.
That can have a significant multiplier effect that allow us to reduce our import dependency from an input perspective, and also allow us to promote our non-oil export economy, right? And how do you then do that? When you identify those priority sector, the government external balance sheet is relatively strong, right? There are guarantees that government can offer that allow quasi-government
Here's what you're missing, because I know where you're going. Here's what you're missing. It's been done before, but you know why it didn't work? Corruption. So that is why at some point
can't
the
do
central bank
anything
said, going back to what you said originally, if you want to understand Nigeria, you have to understand from a different context and a different prism. So that is the conundrum that we have. So the question then is, okay, we're at 3.9% or so GDP growth.
Yes.
Q3 numbers, 4 point something, Q2. We do need to see 6-7%. We've said it here before.
We need
so
some
the question
growth.
will be, and that's
And
the
it's
question
not
I'm saying,
central bank dropping interest rate that is going to give us that growth.
I agree. It's part of it.
Part of.
But that
It's
will
not-
but
If you look at the laggard industries, and you
It's
can
part
actually
of it,
see where the
because
central
if-
bank.
yeah.
Actually, you know
And
what?
it's the manufacturing guys, they tell you.
Yeah.
And
You can
these
look
are
at
the
the
guys that will
laggards in the
create the
GDP
growth.
numbers, and you can
Exactly.
see
That was our
where.
create the
but
growth.
the question is, so like,
And I think Sam again is that it's two ways, right? So you do need the manufacturing sector to start to thrive, right? They need to start to output needs to come out.
We need
Then, more
manufacturing.
importantly, you now need that credit expansion that we were talking about. Consumer credit. So consumer credit now needs to happen so that
credit
spending can happen.
Credit
Across the board.
not just
So
credit.
that is why the central bank is very critical to
I will
growth,
tell you, right? Credit,
policy-wise.
like, hold me to this the way you held me to the exchange rate at the beginning of the year.
It seems like we're coming out tops already.
Credit growth.
I think credit grows.
Credit growth next year. And
Interesting.
it's
watch.
going to surprise everyone.
I expect that
And
too.
the reason
Yeah.
is very simple. The banks, a lot of these banks were hamstrung by the quality of capital that they had, right? This recapitalization exercise has forced them to clean up their
Which
books.
you didn't like in the
I didn't like it, but again, there are certain institutions that I am now understanding really needed to raise capital. My frustration is that it's an indictment on the system because, but we just have to accept that maybe the system wasn't really working properly, because a lot of this retained earnings that were reported by banks was approved by the same CBN, and then basically took them off, right? But it's Nigeria, things happen, right? The point I'm making, so two things. So banks' balance sheets are cleaner. Once interest rates, the only thing that is saving banks' net interest margins at the moment, right, is basically the ability to buy OMO
and treasury bills
and SDF. It's not even treasury
SDF,
bills. Treasury bills is now at 15%.
Oh, so they're getting
15.5%.
SDF at
22%, right? 22%.
now,
And then they're still getting almost at basically effective use of 25-26%. That changes next year. So you are going to see massive NIM compression happen across the banking system. And the only way you can offset that
Do you think OMO changes next year?
Yes,
It
they will
has
have
to.
they will have to.
Yes, this is an expensive
They will
venture,
have
man.
It's an expensive venture, but
It's expensive. On the altar of exchange rate.
The CBN.
So what happens?
The CBN wants to push OMO out of the central bank,
I
and
understand.
everybody's going to buy treasury bills.
I understand, right? But OMO has been used as a tool, as we know.
Which
And I'm
is-
going to go back
which
to this
is-
FX
has always
tool.
been-
If you now compress interest rates, MPR, and then you get rid of OMO, what happens to FX?
That's the problem with moral hazard, because now it kind of sounds
Exactly.
like
Everybody's addicted to it. Everybody's addicted to it. Do you think the RNPCL's remittances makes up for what
we used OMO to do was to buy time. We've
I
bought
understand.
time.
I understand. But I understand. But do you think everything else?
NNPC is now remitting 690 million, and when they clear their backlog, we think that number will go to 1 billion.
But do you think that is enough to make up for the hole that OMO will leave when it goes?
What is the total outstanding value of OMO? It's about $13 billion roughly, or 13 trillion naira roughly. I can't remember the exact number, but it's 13.
Yeah.
Of which we estimate about 40 to 50% of that is held by foreign investors. right? So you are saying, let's say $7 billion or $6 billion. You think the CBN cannot exit $6 billion of foreign inflows in an
but then
orderly manner?
what happens
over
when
a
the inflow?
12-month
I'm not
period?
even talking about the
If
exit,
we have
but
the
I'm talking
FX
about the inflows not coming in. So I'm talking about the hole that this thing creates when the almost
There is
stops.
no hole. The thing is that you are juggling multiple balls. The reason you needed Omo is that your other ball was not in
Wasn't
the air.
there, yeah.
Right? You send that ball up in the air. That air is not put. The question, the risk always is it has to be orderly. And there have to be other alternative inflows. So, for example, the Omo party, I think by 2026 should be done. When that Omo party is over,
I like
you
how you
go
said
and
Omo
buy,
party.
you go and buy NTB, or you go and buy equities. That is FPI, but that FPI has now been transformed. I think we don't understand how crazy it is that our entire exchange rate strategy is predicated on
No, but I
a central
understand.
bank
But the
issued
thing is, I
instrument.
understand. I just don't think that the party ends in 2026.
No, but Sam,
I understand.
With these few points of ours, you do you do agree that the CBN, as of today,
land.
is very important
Yeah.
to the growth conversation of Nigeria, and it cannot be removed. If you remove the CBN, is
The way the CBN can deliver growth for us is to ensure that we have a low level of inflation.
That's chicken and egg. Because at the end of the day, you can't have a low
Inflation
level of inflation. Structural issues.
So
Which also
the only tool the CBN has to drive inflation is to suppress demand. That is the reality. The CBN cannot be responsible for supply side reforms.
with suppress demand. How?
well,
Through different by raising interest rates, by allowing the currency
monetary supply,
by reducing money supply. It doesn't have any other tool.
Wait.
You guys are asking this guy to do a job that he's not equipped to do.
I understand what he's saying, right? So we're not saying, except maybe I'm getting Tunji wrong, but I don't think he's saying the CBN should inject money into us to start lending or start doing a lot of those extreme development finance activities that it did under Murphy. Yeah. There are other ways you can do it, which you mentioned earlier. So you can use BOI, you can maybe, because CBN is a shareholder in a lot of all these government agencies, and you can inject capital there, even Murphy and all that.
Let them do their job.
But it is also important that as we continue to craft this monetary policy, we understand that rates need to go down to engineer growth, because when rates go down,
credit growth at least comes in.
So
I
that's
think
more important. I don't disagree.
Okay.
I think where we are having a nuanced conversation is that rates needs to go down in a way that it doesn't threaten a resurgence in inflationary pressure.
Which is where bravery comes in.
You don't need to be brave. You better be cautious, because CBN will lose credibility if he starts cutting aggressively now.
And then suddenly inflation starts like
Here's the thing.
Last meeting.
Everybody here expected rates to be cut.
Yeah.
Now, the fact that it wasn't cut.
Yeah,
Wait. Let's all go back. Let's all go back to the moment where we realized CBN didn't cut rates. We had questions in our minds.
CBN cut rates.
No, we had questions in our minds.
Cut rates.
No, wait. We had questions in our minds.
No, but they changed the corridor. They didn't change the corridor. They changed the corridor.
People should not come in the
So let's not I don't even know. Can I say something different? You need to look at what the marginal rates. Your marginal. What was the short-term interest rate that was driving?
It's short-term overnight. Yes,
in the market.
But how did it impact the real economy?
Wait, Sam, let me finish.
So that's my thing. That's what I'm saying.
What was system liquidity?
No. Wait.
Is that improvement in system liquidity that would further affect the real economy?
Wait. Let's all think about it. That moment we all heard CBN didn't cut rates, the first thing that came to our minds individually is that maybe the CBN doesn't believe the economy has recovered as much as we all see it to be.
No,
the inflation numbers have not really fed in through, or maybe they don't even believe the inflation numbers. One of the things
It was inflation expectation,
we
right.
all felt CBN possibly doesn't believe something to be completely true.
So no, but you
Now
need
that,
to.
that
so,
starts to
so
put
you
a
need-
doubt. That starts to put a doubt in the minds of, now we're analysts here, right? It puts a doubt in the mind of analysts. Now imagine people who are investing, bringing money, all those kind of capital
If I was
injection.
bringing money, I would be quite pleased with the decision that he's made. The simple thing is this, right?
If you don't believe in your economy, why would I believe in
you
it?
need to be confident. It's not a matter of belief in the economy or lack of belief in the economy. You need to be the worst thing that Kaduso could have done is cut aggressively early and be wrong.
No,
in
nobody said
cutting
he should have cut
because
aggressively.
because inflationary direction then changes. It's better to wait, right?
And when it changes, you're not
And then when it
up and
changes,
down.
you're not up and down. Plus the
Yeah.
steepness at which you cut will have a higher delta to the economy. So let's say, for example, you cut gradually and you have to smooth it over a 18-month cycle or a 24-month cycle for you to do 500 basis points. It will be less impactful than you have to cut 500 basis points over 12 months.
What was the last cut?
And for you to be able to cut 500 basis points over 12 months,
3
you
or
need
4
to
years, 3
see
years ago or
clear
something.
evidence that inflation has been anchored and inflation expectation has been broken.
Inflation expectation, yeah.
Inflation in Nigeria has not been
Yeah,
broken.
inflation expectation. Inflation expectation. Yeah,
So,
yeah.
so bottom line is, one, we don't believe that the inflation numbers that we're seeing now can last. It's still fragile.
No, but I think
it's-
also
it's
that's
fragile.
in December.
Yeah.
It's fragile.
Then
And
secondly,
also that's statistical anomaly in December.
secondly, we also don't believe the market rates that we're seeing now are also real, because you're seeing yields at 19-18%. You're seeing treasury bills at 15-16%. So you're seeing
But they're
that
lower.
happen.
They're actually lower.
They're even lower, exactly.
Yeah,
So there's a
yeah.
huge disconnect between
But market is forward
yields.
looking now. So the market is telling you what
This
it
is
thinks
where it's
inflation is going to be
expected.
in the future.
Yeah.
Okay, so NPR is.
So again,
Should
if
be
I buy a
backward
10-year
looking.
bond, if I buy a 10-year bond,
We're looking at short-term rates here.
okay, so
Short-term yields are all dropping.
So like if I buy what's the word? If I buy a 5-year bond and I get 16%, right? I'm basically saying that, you know what, over that 5-year holding period, my average inflation for that period will be lower than
Yeah, but I'm talking
16%
about short-term rates.
So
3 months, 6 months treasury bills
in
rate.
Nigeria, unfortunately, short-term rates is largely driven by liquidity.
With 1,000 basis points.
Yeah.
But you see how long Ghana held for?
Yeah.
Inflation got to 10%.
Yes.
Before
Yeah.
Ghana started to
Before it started
accelerate their
aggressively,
cut.
yes,
Now
yes,
Ghana
Inflation
is
is
at
at
6%.
6% inflation.
Yeah.
You see, that's the
Yeah,
level of
yeah,
disinflation that you can engineer.
And you're there.
And when you do
Yeah.
that, the fuel, it's almost like you
And
basically light
Ghana's inflation
asset prices
target,
on fire.
Ghana's inflation target is 8% plus or minus 2, right? So
Yes.
it's in the
It's
target.
in the target.
Yeah.
So they allowed the inflation to get into the
Inside,
target.
yeah, and then they started cutting, you're right.
So we don't even know
Yeah.
what our target is.
No, we don't
They'll
have a
publish
number.
it. They need to, the work that my team is doing internally. I'm sure these fine econometricians, the fine econometricians inside CBN, they'll come up with an inflation target. But you need to know what your non-accelerating rate of inflation is. I have some anecdotal evidence to support this. Is remember, as the market rallied, right, a lot of brokers were providing margin products to retail investors, right? And everybody thought this rally is going to continue and is going to be sustained. So some of my anecdotal brokers I speak to, they are, because I always ask my brokers what the size of their margin programs are, the ones that
What's the average size?
Just that they usually
Average.
don't want. So like, there's one broker, for example, that had like 10 billion outstanding, right? So I use it as a sense of, I look at the pace of growth of those margins.
Yeah.
So when the first conversations around CGT happened, I think it was the one you moderated, if I remember correctly. That was end of September.
Yeah.
That's kind of sent alarm bells to everyone, right? And that was when I was getting calls from ex-clients, foreign investors saying what is going on, both private equity and public. And then the way I trade, right, is I have like my portfolio previously has 10 stocks. So I have very concentrated portfolio. And oftentimes, I like to have what I call clear liquidity headroom. So if I like a company very well and there's a big seller, I just take them out, right? I remember I won't mention the stock, but I remember for one of the stock that we own and we really love, right? During that period, there was pressure on the stock. So I called the broker that was selling, saying, I don't like this price action, right? I need to know, because sometimes when I want to do that, I'm like, okay, I'm not going to engage you until I know your full size. I need to know the full, and I've done that quite often. I need to know your full size.
And they tell you?
Of course, because I execute, right? It's not like I bluff, right?
Yeah.
Sometimes it's a game. You play a game.
Yeah.
But when you're credible and you've done it a few times,
okay,
they know
you can take.
They know you can take it.
Okay,
right?
okay.
So I was like, okay, I need to know the full size.
Yeah.
And even for me, and I run a reasonably decent book. When I found out about the size behind the stuff, I literally first dropped the phone to think if I'm ready to take on that risk.
Yeah.
Right. I'm probably not the only one that had that intelligence.
Yeah.
So when you are running a margin book as a broker,
you can see
and
everything.
you can see that happening.
Yeah,
You
100%.
run for the hills.
Yeah, 100%.
Right. So even though the foreigners ended up selling later.
Yeah.
But that feeling that was triggered by the CGT, in my opinion, basically created this spiral effect.
Exactly.
And
yeah,
that day that the Ministry of Finance was on the exchange, I feel what happened is that a lot of margin position got triggered.
Yeah.
So there was forced selling and basically bids disappeared.
But funny enough, the market closed positively that day, but the next day, that's when the selling
No,
started.
it was negative.
It was positive. The day he came on, it was positive.
The whole screen. So when he was in, when Baba said he was going to look into it, we all thought he was going to come up with a big announcement the next day.
And then that's when he
so everybody, and you know the way Nigeria is. Yeah. There's a lot of people that tend to have information before the market. It's a failure of the market information
Massive
credibility system.
That's what happens to you now.
So what happens is that somebody may be close to the minister or close to FI or close to somebody will just rush and say, they're going to do this, they're going to do this, and send instructions to their brokers to start buying indiscriminately.
Yeah, but also.
But when that didn't come out, then people are like, those people are not high. There are not a lot of high conviction holders in this market. So it's a momentum market up and down. So when that didn't materialize, which is why I still want them to come up with clarity, right? So that we can just get rid of this CGT thing and move on. Let's know what it is. Let's know what is going to happen. And then we can go. So my point is, CGT was, in my opinion, the catalyst. But the market structure, right, drove the outcome. And this is the frustrating thing for me, because this is the concept of risk premium. The idea that you can come to the market and say something and backtrack and think the market will get back to where it was before.
It's just crazy.
It doesn't work like that.
It doesn't. It doesn't. You gotta be sure of what you're saying.
So before you go and interact with the market, you need to be super tight on your communication. The communication strategy in my mind, from the fiscal authority on this tax thing, as it concerns the market. Communication strategy across other things were good, like PIT, VAT, but as it concerns the market and the fragility of a system where you see prices real time, I don't think they spoke to the right people to hone that communication strategy properly. And they confused the market with the communication. And if you have uncertainty, the people who can will just say, you know what, guys, I'll see you later.
Come back later.
And some of them may never come. And that's the frustrating part. So yes, it's been a very, and also it's also not helped by the fact that we've all made money this year. So if you've made...
Market's still up 9%.
Yeah, so if your portfolio is up 40%, and you know what, I force sell my position, and I end up with 30% up, you're not that pissed.
Yeah, I'm not that pissed.
And I think that's what happened, right? So adding everything you said with just taking profits, because if I look at how I manage my portfolio, once I heard CGT, I don't know what it is. I'm not sure what he's trying to say.
Investor. Say, let me stay.
Right.
Stop serious.
And I'm out until I get clarity. Or I'm out until the 1st of January when I think, okay, an efficient market prices these things in. Let's all assume the market is efficient and it has all the information priced in. From the 1st of Jan, it's priced in. So I'm coming in,
fresh. Yeah.
Whatever price it is, okay, that's the price.
At least you're fixing, you're hedging your cost already. All right, guys.
It felt like a bit of I don't want to use the word own goal, but we didn't need to be here because Q3 results were strong, and I felt like market could have rode that momentum.
At this opportunity, because I also hear some big wigs are using this opportunity to buy. I don't know if you've been noticing. We've been seeing a lot of mop-up happening.
If you
I don't want to say something that I regret, but if you have capital that is patient, and patient I mean 12 to 24 months, the valuations
That is around
that
right
are
now.
around
is
right
just
now
incredible.
I mean, Zenith,
You're seeing
for
GT
example,
at 80 or so.
Zenith,
Or 70.
Zenith is at COVID levels multiples. I don't
just
look at absolute
madness.
pricing when I look at stocks.
It's pure madness.
So when Zenith got to 9 Naira,
Yeah.
the multiple that it was trading on is the
Is where
same
it is
multiple
now.
that it
which
is
is
right
2x.
now.
Yeah.
2x or so. 2.5x or something like that.
So
Yeah.
it's on 0.4 times book for a book
Crazy.
that is clean.
Below book.
A business,
Trading
earnings multiple.
trading below book.
is a clean
Yeah.
Below book has always been not. They've always. And
Yeah, but this is
below book
0.4.
with capitalization on
Yeah,
top.
exactly.
below
yeah,
the market, that
yeah,
capital they raised, the market didn't even give them
Doesn't
credit
price
for it.
at all.
Yeah.
And that capital is still clean. It's still in treasury bills. It's not like the capital has taken any risk. And then on top of that, they took a 800 billion
Right down.
Naira shower.
Yeah.
That is not going to happen next year. So I normalized their Q3 numbers, which was about 20 billion in loan loss provision, to get a sense of how much they're going to take next year. It's about 80 basis points. Shock that and take that to 1.5
Yeah.
or 2%. That's
still
about
good.
600 billion
Yeah.
of earnings head start that they have next year.
Yeah,
It's going to be the fastest growing
and
market next
if you
year.
speak to, so if this war, if we call it the war, goes on for another week or two, what could we be facing? We've seen exchange rate depreciate. I don't know if that's related. We've seen fuel prices slightly go up.
Yeah.
Right. Brent crude prices up as well, way beyond our budget benchmark. What does this mean? I mean, we're all investors here at the end of the day. What are we looking at?
I mean, this is what I spent the whole day in the office trying to figure out. I don't have the answers, but I'll just tell you how I'm thinking about it, and maybe you can get to the answers that way. There are multiple channels, right? Channel one is the crude oil price, right? It helps the terms of trade quite significantly, especially within the context of increasing product volume. And I think we will see product volume because of prior investments that have been made over the course of the coming months and quarters.
Product volume within the next 2 weeks?
Not 2 weeks. I'm talking about, I'm looking at a 12-month outlook. Right?
Okay.
I mean, 2 weeks, you might as well just go to Vegas and gamble. I have no idea, right?
Okay.
But I'm saying if this sustains and oil price stays elevated, how does it affect Nigeria,
Yeah.
right?
On the medium to long term.
On the,
All right.
yeah. So I'm saying 6 to 12 months, right? So oil price stays up. We have very strong positive terms of trade. So the external account strengthens a bit, right? The trade-off, however, while you have a positive terms of trade, the inflationary impact is also higher because now you have a petrol product market that is a bit linked to the global market, which is why Dangote has ratcheted up prices, although it's still below import parity, but it's gone to like 1,000 something very, very fast because it doesn't, I mean, at that scale of refinery, if he loses like an extra $2-3, he's blown up, right? So it means inflation basically doesn't decline as fast as we anticipate it to be because there's a pass-through effect on the transportation side, right? So it's that balancing act that, okay, yes, you have more confidence around your terms of trade and your external account. Inflation is weaker, is weaker, so it's a bit stickier. It doesn't decline as fast, right? And then there is a final angle around risk appetite and confidence, because we know that our exchange rate stability and credibility has been anchored on short-term portfolio flows, right? And this is largely driven by risk sentiment, right? So in a world where
There's so much uncertainty.
there's global inflation, and likely, because with what is happening in big tech, likely the consumer wealth effects is going to decline in the rest of the world. We might have a significant pullback of capital. So the play-off that we're trying to work out in the office is, does the positive terms of trade that comes from high oil price and improved product volume, right, outweigh the inflationary dimension and the capital outflow? So some of the work I'm doing is like, okay, what is the stock of OMO? What is the stock of MTB? What is the stock of bond? What new bond maturities are due over the next couple of months, over the next 12 months? And I'm looking at that stock and then I'm comparing it to 3 factors, right? 1 is the price of crude. 2 is the volume that we expect. And 3 is the improvement in the plumbing of the pass-through of oil revenues to the fiscal revenues and the reserve. Because those 3 factors are positive at the moment, especially on the back of this PSC contract that NNPC has said, and I understand they're also going after the JV. Right?
Yeah, they are.
So they're also going after the JV. So, I mean, our estimate is that PSC alone would unlock about 1.2, 1.3 trillion of incremental revenues at 2025 prices. So 2026, that is even higher, right? So on top of that, right, you then have higher oil price, higher volume. So you have these dollar inflows that are coming. We haven't quantified it yet. So that's the work we've been doing in the office. So does that allow you to easily exit the stock of foreign-owned portfolio investments in Nigeria in a way that is not disruptive to prices? I can't answer that today, but that's the framework that we're using to try and figure out what happens.
I will still be.
There's a part people are not really focusing on. A huge part of the US bubble has been driven by capital recycling from the petrodollar states to the Chinese surplus to the Asian surplus and those guys. And this is why, like, even at full employment, the market was easily tolerating 6.5% deficits in the US, right? Now, like, there is a need, right? With all these tripolar world things that we're talking about, people are like, you know what, this dollar that we're sending to the US, we need to spend it at home. For example, Europe is a surplus economy. Europe needs to spend a lot of these dollars at home. Even the Japanese, that have been a source of massive carry trade funding currency, are telling you that we need to spend. Those ones that even worse, they don't even have an army and they have nuclear armed North Korea next to them. So
Who has been flexing, by the way?
so those ones are like, because we need to redevelop, we need to reindustrialize this excess dollar that you are earning, put it at home, right? Chinese, the same thing. So my point is the capacity to continue to fund excessive US deficits in the US while you are driving those deficits higher. Because remember, 6.5 times of fiscal deficits, these are crisis level deficits number, right? This is with global financial crisis kind of deficits that we ran, COVID kind of deficits. So this is our starting point. And I think it's going on to, back to what Dele said, it's going to go into overdrive. So within that context of excessive deficit spending, very high level of current account deficits, increasing at the margin. Dollar will always remain a dominant currency, but at the margin, the trust is not as strong, right? So when you get, for example, China recycles 100 billion a month of dollars. That's the deficit that it gets, right? In the past, that 100 billion, it will go and buy Nvidia, go and buy this, go and buy that. And obviously, now it's thinking that 100 billion, maybe of that 100 billion, maybe 40 billion, I should go and buy something else. It will still put the 60 billion, but the market has gone from recycling 100 billion a month to now 60 billion. That's a massive impact on pricing, right? And also, there's something that has happened in the last month that people have not paid attention to. The renminbi has been strengthening quietly, right? So for a lot of local guys, because this 100 billion a month is not the government that has all the money. It's entrepreneurs that have sold products to the US and is stuck in bank accounts in Hong Kong. Those guys have been keeping the money. So when you end that excess, you keep the money in Hong Kong, you in HSBC you use it to buy treasuries or use it to buy Nvidia stock, right? And you've been losing 2%, 3% a month, a year on the renminbi, and your real estate alternative asset is down 25%. So that's a good trade. That's been a good trade in the last decade. So these entrepreneurs have been doing it. Now, if you think that the Chinese currency is going to be strengthening, which I think it will be, right? And then there's really concerns around the US, which I think there is. When that money comes, like, do you really want to buy US assets? Maybe you go and buy PetroChina. Maybe you go and buy the beating down real estate in the market. Maybe you recycle it and go and buy another. So the point I'm making is the incremental direction for purchase of the dollar is negative. So within that context, I agree with Dele completely that, yes, you might see risk-related strengthening in the short term, but I actually think the direction is probably, I think there's a structural bear market in the dollar that is evolving.
So are you guys essentially unwinding your dollar assets?
No, I'm not.
I am.
So why are you then betting against it?
That's different because I have a 90% cost base in USD
Okay.
and 10% in Naira. So my balance sheet is very different from everybody else.
Okay.
Since November 2024, outside of my house in the UK, which I bought before I moved to Nigeria, I don't have anything else outside of the country.
Isn't that a risk?
Yeah, but it's worked out very well in the last 2 years, right? In the last 3 years, Naira assets-wise, if you've invested in the stock market or you invested in my products, you're probably up 6 times. Right? At some point, you will chop cane, but the macro is aligned, right? This is why you're spending a lot of time trying to understand the impact of this. The point I'm making is it's risky, right? Of course, it's risky. However, like, I had for example, I had pound liabilities when my family was in the UK, right? So I had to pay school fees, I had to pay mortgage, in the summer this year, I changed that. So I brought them back to Nigeria, right? So they are here now. So all my cost is Naira. So my only.
So on that basis,
So my only liability is my small mortgage that I have in the house that I
know,
bought
but
in
at the end of the day, as you're going up the ladder of that Maslow's theory food chain, at some point you want to own asset after Nigeria. Doesn't that now become you want to own you want to roll like
so when you are rich like
Samad,
when you are rich like Tunji when
But you people see that it's that bullying. I mean, it's that bullying.
when you are rich like Tunji, right? So for me, I'm at the stage of my life. I'm talking about personal finance here, not the fund, right? I'm at the stage of my life where capital accumulation speed is very critical, right? At some point, it's going to be capital protection, right?
Okay, so we're like okay.
So my priority
is
capital accumulation.
That makes sense. It's very important to discern that.
We have this mad system where 36 commissioners of finance we sit down in their house all month. And then one Wednesday, or what day is FAC again? One Monday, they'll go to Abuja. They will sign paper. They will collect money. Zero accountability of money that you're collecting. So the point now is that Abuja money that is there makes you intrinsically lazy. Incentives are so important to drive human behavior. Right? When you're in Borno and Borno may be on fire and half of your state is run by Boko Haram and you cannot make any single money. But at the end of the month, money go still enter your account. What is the point? There are governors in this country that spend more time in Abuja than they spend in their own state.
Yeah, but the current system still encourages that.
So let me
regardless.
Finish. So what I talk about weakening Abuja is let's reduce to a very bare minimum this dependency on this federal revenues.
But what we're saying is an increase in that now.
But again, that Abuja thing still there. So yes, Lagos is getting more. The point is, when you see, say, your neighbor, right? If Lagos gets his act together, is growing very fast. Soon, that your Lagos guy will start telling you, don't come here, you go vex too, right? If you're a governor, right, you figure out how do I make my own people productive? Because the beauty of this country is that I think almost every state is endowed with the value that it can generate for our country.
Which is my point,
right?
Sam.
So the reason why that value is not mined is this incentive structure that this federal structure has created for us. We are living in a federal system that is not really federal. It's a very weird unitary system where everybody goes to Abuja, but you cannot organize your state that you're supposed to be I won't even call it governor because it's more powerful than governor. These guys are like dukes, right? Like medieval dukes, right? You're a duke, right? And you're not deriving value from your people. And the beauty about deriving value from your people is that your people that you're deriving value from become a stakeholder
in your conversation.
And that's one of the reasons I love Aliko. Because Aliko is a stakeholder in the Nigerian project. He cannot allow Nigeria flame because he will flame with it. Right? A lot of people, a lot of governors, a lot of political leaders that we have, this country can rot for all they care. They don't give a damn.
So
because they are not invested in the Nigerian project. And frankly, us as business people, we don't even want to do anything with it. If I have to go to my governor in Edo State to get access to enabling environment to be able to build a factory, and then he taxes me, and I pay taxes to him, and that is how he's able to deliver goods and services to the people. Before he does anything stupid, he will call me. He will.
Because he knows that that's where his money
comes from. Because his money is coming from. The organic cocoa and the synthetic cocoa, the average people will go and buy the organic cocoa. So the only way you can try and ensure that you reduce that dependency is to come up with a lot of environmentally global warming, carbon. So what happens? So are hypocrites. We need to the point I'm making is that the window is not going to be
there forever. Yes.
So if the global market accepts synthetic cocoa today, and actually when you speak to like the big cocoa producer, the proportion, they keep diluting the proportion of actual cocoa that is in all the chocolates that people consume. Because they don't want to be exposed to the vagaries
risk,
of
yeah.
basically
This
having
country.
Cote d'Ivoire and Ghana
Yeah.
dictating terms for
For them,
right?
yeah.
So that window closed as technology, as we continue to make leaps in technology, which is bound to continue to happen, then what is a deep, intrinsic competitive advantage for
That
us
we
in
need to
Africa,
continue to have,
which is
yeah.
the availability of primary commodities become things that you can't monetize. And if you don't have the value add and industrial base to make advantage of those primary commodities, then you will do it. I get them before, but
All right, guys. So let me get Sam's view as well on macros. I've reeled out some numbers already.
Okay.
yeah.
What are your views?
So I think the way I look at it is right. It's the direction of the impulse. So both the fiscal impulse and the monetary impulse. And what do I mean by that? And this is why I sort of disagree with Arnold's view around the expected slight weakening in the exchange rate. Right. The global environment at the moment is very positive for risk taking. Right?
Oh, okay.
That's one because Naira, dollar is
Dollar's
weakening,
weak, yeah.
which is a major funding currency for carry trades, which Nigeria is a beneficiary of, right? So that's one. Inflation number is all over the place because of the rebasing, so it's really difficult to make a sense.
It's sort of like
But I think we've sort of accepted.
Well,
we've accepted that this is-
so food inflation is accelerated, but there's some
Yeah.
seasonality there because we're in the lean season.
Yeah.
Core inflation has gone down, but it hasn't. It's not a very strong. At least the data is not a very strong disinflationary trend, right? Which is why we can debate the direction of interest rates later. But speaking on the macro, there's been significant improvements, right, in what I call the fund flow pulse, right? I'll give you an example. Post the removal of the subsidy, right, there was zero remittances or close to zero remittances of dollars from NNPC into FAC, right, and into the reserves, right?
Sorry, say it again.
There were close to zero remittances.
remittances
So
from
like
NNPC.
10, I think it was, the data I saw was like 10 million, 10 million months.
Yeah.
That number has now, as out of May, from what I heard, right, NNPC is now remitting $400 million
a month,
into FAC.
They are doing 2 trillion these days. Every month.
May, June, July, right? That is in addition to the 600 million plus that is coming from remittances flow, right? So you look at it from a flow of fund perspective, you have what looks like a very stable exchange environment, especially within the context of massive demand contraction. This is an economy where we used to import $22-23 billion a quarter worth of goods and services. We are now doing 12-13 billion. So demand has shrunk, supply has increased. So that is positive. Even on the fiscal side, that people seem to make the argument that it's bad, right? What is maybe bad is the fiscal side on the federal budget. One of the work that we've looked at recently is basically the consolidated accounts of the fiscal position.
That's federal and states.
Right, which is basically 50% of your government spending. So you can't ignore it, right? State revenues have almost doubled, right, through this reform period, to the point that on aggregate, the state is in a surplus, right? And the states are spending 60% of their budget on capital expenditure. So 50%.
Where is this data coming from?
From the World Bank. Right. So 60% on capital expenditure, right? So put that in context. The state and the local government are roughly 50% of total government spend, of which 60% of that 50% is capex, which is why people like WAPCO, Dangote, has been showing you strong volume growth in cement. And everybody's like, what is happening here? This economy is in a recession. Who is buying all this cement? What is happening is that 50% spending we've ignored. So yes, the deficit in the federal is expanding. And some of the reasons why it's expanding, there are lots of reasons. One is the proportion of VAT, in fact, has gone up. And the take of the federal government on VAT revenues is smaller. They take about 15% of VAT revenues. The state government and the local government takes 50% and 35% respectively. Number two, there are these interventions. So there's a lot of accruals that the federal government is owing the state on fact that they are now repaying, because the commissioners and finance and governors are saying, you took my money during the Buhari era,
give me back.
Please give me back my cash, right? And then there are some intervention funds that are designed to support things like infrastructure and security that is going straight to the state. So that's why you haven't seen the increase in FAC revenue translate directly into increase in federal revenue. So that's one. So that gives me a bit of comfort. And the resilience of even the oil portion of fiscal revenues, I'm talking federal at this point in time, has been stronger than anticipated, even when you factor in the decline in the oil price. So the fiscal position is a bit messy because we need more transparency, and we've discussed that during the previous episodes that we have. But it is quite clear that our fiscal position is stronger. So fiscal is stronger, fund flow is stronger.
Fiscal is stronger from a federal point of view or from
a blended consolidated
point of view.
So let me put this in context, right? The total fiscal deficit of the federal government is about 4.5% of GDP, right? The fiscal deficit of the consolidated states and local government is plus 0.3 to 0.5% of GDP, is 50-50. So when you blend the two together, we are talking about a consolidated fiscal account of around 2.3, 2.5% of GDP. That is not crisis level deficit spending.
But Sam, when you're looking at macros, are you going to look at the consolidated? Because I mean, like, are you more exposed to consolidated? I mean, are you more exposed to the states, or are you more exposed to?
So this is okay. So it's a very good question. When I think about the economy, right, I think about the impulse of the three biggest economic agents: the household, businesses, and the government. Right? If you miss out what 50% of government is doing, you miss the data completely. So we all focus, and it's probably a problem because I think this is what the government needs to spend a lot of time on. We all focus on what is happening in Abuja, and we miss
entirely what's happening.
What is happening in the states and what is in the local government.
Yeah, local government, yeah.
But the reality is that we are macro people. You need to look at what is happening across the entire economy.
And we can also say that the revenue drive for the states have been very significantly more
IGR
aggressive.
is up. Fact-related revenue is up. These guys, governors don't even know what to spend money on.
And that calculated revenue.
Sam, but then what I don't get is sorry, Arnold. What I don't get is, okay, so we're seeing all this uptick from states, and I agree, you're seeing a lot of infra spend across states. We also see that in data that we track, but people are not feeling it.
So again, I think Tunji said something at the beginning. Macroeconomic stability is not the same as economic growth, right? For people to start to feel the impact of reform, you need to grow
the economy,
capital. And to do that, you need to kickstart what I call an investment cycle. Right.
Yeah.
So we've achieved macro stability, right? It's basically like having a patient that gets brought into the hospital bleeding, right? Before you diagnose the patient and treat it, you need to stop the bleeding first. We've stopped the bleeding, right? Now we've stopped the bleeding, the real open heart surgery, right, of treating the ailment. And in my mind, is basically across different sectors of the economy, is kickstarting an investment cycle. I'll give you so like one of the reasons why I'm optimistic on the outlook for the markets, for example, is just the fact that equity risk premium has gone down, which is why valuations
which is kind of strange. Why is equity risk premium now?
Because of macro stability. The beauty of this is that when equity valuations get to a certain level, it then makes sense to use the capital market as a way to fund your forward-looking investment, because the dilution you take or the cost of borrowing later, once we start to cut interest rate, is actually lower, and you can fund your capex, so you can kickstart an investment cycle that way. In the oil and gas sector, there is already evidence that an investment cycle is kicking off, right? Pipeline availability is almost 100%. Rig count is growing, and basically the government is basically said, guy, whatever you want to drill, whatever terms you want to drill, come and drill and get production up. The cynics will say he's mortgaging the future of Nigeria. But this thing is under the ground. If you don't bring it out and sell it, it's even worse than mortgaging the future of Nigeria.
But let's talk about this income per capita.
Let's talk about this
income per capita real quick, right? Because I see how it also affects even equity prices and consumer names, right? Because we talked about this yesterday, where you look at Nigerian breweries, for example, top line is price times volume, right? So on the price side, you're seeing the increase in top line because these guys have increased prices, but the volume side now is a question because the volume side comes from consumer demand, and consumer demand comes from income per capita. So I want to kind of, I want to expand a little bit. How does one now increase income per capita to the point that the consumer stops to feel what they're feeling, and then it bleeds into these equity prices and these stocks? So income per capita, how can we increase our income per capita to a point that it's comfortable for us?
But that's what he said. Investments.
But
that is productivity gains.
Yeah.
And that is
Productivity.
investment you need investment for productivity.
Wages,
right?
wage increases.
And obviously with where the exchange rate is, we are very competitive, right? Relative to most of our global trade partners. So that can drive an investment. And when you start to invest in the economy, demand naturally goes up. When demand goes up, I mean, we are currently in the financial sector, which is currently where we've seen the current massive increase in what I won't say productivity, but for example, Arnold, I'm sure at the end of this year, all the staff that work for you are going to get an increase in pay, an increase in bonus. If you don't, you are going to lose them. Right? That is because financial reforms tend to first hit the financial sector first, right? If the reform doesn't stall,
Financial sector first.
If the benefit of financial reforms hits the financial sector first.
Before it starts
hit other parts of the economy.
And I know that's really done well this year, by the way.
I'm sure he has, right? Because most people, like, to be honest, you didn't even really need to do any work to have made money in the market this year, right? So most people who have, if you don't pay up for the people that you have, you're going to lose them because somebody else will poach them, right? So that is growth in income per capita, right? And you will see that in oil and gas. So for example, right, I'll just use a micro example. Rig counts have gone up, right? There's massive demand for rigs, right? By definition, there will be massive demand for people who work in rigs, right? The pricing for rig also goes up.
So I guess an increase in investment, because oil and gas is an increase in investments, right?
Correct, yeah.
So increase in investment comes down to the
So the
consumer
real debate, right, the next leg of growth of this reform is no longer macro stabilization, but can we have the sets of policies to help us kickstart an investment cycle? So obviously we need to
Who goes to collect the money?
Wait. so
which is also why I'm surprised equity risk premium is dropping.
So as at today, the manufacturing proportion of GDP is not significant.
It's still almost 20%.
So it's I don't think it's that big. I can't remember.
Industrials is almost
right. So I have no doubt that sector is going through pain, right? But the pain that it's going through is basically a function of bad decisions that we've made in the past, right? And which we are now paying the bills for, right? So the price for. So now, when you now have a stable exchange rate, you have inflation that is high, but I think the trajectory of inflation is lower, right? I'm a bit saddened by the fact that we changed the inflation time series when we did. If
we didn't have to,
we will be in a disinflationary cycle.
We didn't have to. Now, we didn't actually have to.
Because anecdotally, you are seeing that the rate of increase in prices have slowed down materially. Prices may not be falling, right? Because sometimes people forget that lower inflation is not falling prices. But so the rate, clearly the rate of growth in inflation have slowed, right? And I think this statistical anomaly with the new series, and I heard the CBN is using their own internal data to track inflation. I'm hoping that that's showing them this inflationary trend. So you need to see that. So I agree with the pain in the manufacturing sector. I agree with companies that have had to shut down, right, because of difficulty in accessing credit and the exchange rate impact that has had on working capital, right? But now we have to basically restart, right? Which means that there's a lot of capacity that has been lost, right? As we start to recover, that capacity needs to be rebuilt, right? Which is why, thankfully, the banking sector is now capitalized. Loan growth needs to kick off, right? The size of working capital financing to the industrial sector needs to go up, right? But for that to happen, right, you need to start to see a shift and a trend lower in inflation and by extension, the reduction
Of
in
interest rate.
interest rates. So it's a sequencing thing, right? Sometimes when I speak to people often think that I don't care about the manufacturing sector, right? But the manufacturing sector has had to bear the brunt of this adjustment, which is sad, but I think it can lead the recovery because it has suffered the most in terms of
pain. Yeah.
But some of them, I mean, Arnold, we trade EM, right? And we know that the political economy is your single biggest determinant of economic direction, right? So if you have sudden change, right, in the political environment, that risk basically bringing all of this to a screeching halt. It's not like I'm an advocate for this government. I'm just speaking purely from an economic standpoint more than anything else, right? So to your question, is it possible to remember this sort of reform is not new, right? The Eastern Europeans did it when they joined the European Union, right? Turkey has been through this journey. Russia has been through this journey, right? It's really about the delta, right? Which is the rate of change, right? As long as the rate of change is positive, then you would now be able to. It's a problem, it's a hurdle, right? But what is determining our interest rate outlook is the inflation in our system. I think we have structural inflation. I don't think monetary policy can do anything with structural inflation. The job of Cardoso is to ensure that monetary induced inflation is reduced to a bare minimum. And there's debate as to what structural inflation is. Is it 12%? Is it 15%?
I was about to,
We don't know.
ask you that,
But I think there is a high degree of confidence. And I think when I look at the direction of PMS prices, which are inputs to inflation, when I look at exchange rates, which are inputs to inflation, food has been messing up recently, but I think once we go into the harvest period and the rainy season goes up, because rainy season have messed up with food supply chains, right? That is positive for inflation. You combine those things together, right? I actually think, and then obviously, I think keep not loosening monetary policy too fast, right? I think you have that trend lower. Inflation price level will still be elevated, but the rate of change will materially decline, which is how an economy that has structural inefficiencies like Ghana can be talking about 10% inflation. Can Nigeria, within the next 2 years, 3 years, get to a 12, 13% inflation if we don't have external shocks, right? And we keep the direction of reform, I'll bet that is possible.
I know.
Yeah, I mean, your question too, can a country grow with double digits MPR? Yeah, I mean, it can't. I think we struggle with that. What Samson has pretty much answered it. I think that the question is, how do we go from 27.5 to lower as quickly as possible?
Exactly.
I can tell you.
Like how they going to cut? Like where do they? Like are they going to be? Like,
It shouldn't be aggressive, but I think
we see. I think we see for the rest. So we see 100 to 200 basis point cut this year. I think we have to.
So you can start with
sitting with this
200 basis point
100 to 200 basis point cut this year. I think we have to.
I don't think so.
You don't think we do? I think we do. At least 150. Between 100 and 200, I think we do.
So you could start with the because the big fear everybody has is inflation. You can start with that.
But inflation is cooling though.
It's not cooling fast enough for you to be able to have those kind of cuts with your interest rate, right?
So you don't think we see 100 to 200 basis points?
I think
this year?
our next cut is 2026.
So at what point does
2022? So if we watch it 2025 and it's still everything remains.
If I was Cardoso, I will hold September and start my cutting in November when I have more data points that were in this inflation. And remember, October was when we deregulated PMS prices and we took the subsidy out. Like de facto, not de jure. De jure was subsidy gone speech, but we still had subsidy up until October last year. So we are now lapping very favorable comps from an inflation direction perspective. And remember, our exchange rate strategy still anchors significantly on FPI inflows. It's going to be substituted by oil and gas revenue over time, but you need to give it time to play out.
But the thing is, the FPI comes through OMO, right? So as long as OMO is still where it is, as long as Omo is still where it is, you're still going to get your FPI. So
No, so
the MPR doesn't necessarily.
I personally hate that market segmentation.
Yeah.
Having a country issue instruments with the same duration at different prices creates
mad.
massive
It's
distortion.
absolutely mad. It's
in the
absolutely
economy.
mad.
What can you do?
agree.
Because
agree,
I
but
mean, there's an
that's where we are.
opportunity cost.
Yeah, but that's where we
There's an
are.
opportunity
So
cost.
there's
And if you
also-
don't
there's
do that,
also
then
the
you,
reason
then
why-
you face
But you
exchange
can't- but this
depreciation,
is crazy.
which
That's where
then
we are.
This is
causes
That's where we
this is
are.
one of the
Interest
reasons
rates.
why. This is one of the reasons why, for example, the banks are not lending, right? Because
They know they can get Omo.
because the local citizens are basically being priced off the NTB curve, which is affecting the yield they're offering on fixed deposits and on deposit placements. But they are recycling that liquidity and putting it into OMO and putting it into SDF, right? At basically 0% cost of risk.
But that's
So it's
even
almost like
strange.
the central
Sorry.
bank is paying the banks.
But that's even
We
ironic
are
because
subsidizing
I
the
don't know.
banks.
I'm sure
That's
you're
what it
getting
is.
calls.
That's what it is.
I'm getting calls from banks. I'm sure you're getting calls from banks to come fix money.
Yes.
And some are offering mouth-watering interest rates. Microfinance banks are even offering way higher interest rates.
Yes.
So where exactly?
I think we're
is-
here.
Again, on an individual basis, some banks that are relatively short liquidity are really struggling because of the CRR impact and the cost
nearly
of debt.
all banks. No jokes.
But I am telling you,
All
right?
banks.
I am okay. The question now is, wait, where NTB is, right? You go to a bank that has a liquidity surplus. Let's say, for the sake of argument, a Zenith or a GT. They cannot be offering you.
They don't need to.
24%, 23% on fixed deposit.
They don't need to.
The
Because
tier
they
two
don't need
guys
to.
will be
Yeah, they
offering
don't
Yeah.
need to.
Yeah,
Yeah.
it
Right.
depends on how much
So
you have.
my point is, like, by having this market segmentation, right, you are basically commandeering economic resources from the rest of the economy into the banks. I'm a shareholder in the bank, so I won't complain, but into the banks. And what pisses me off a bit is foreign investors, right? And I think it's an implied subsidy. I would rather have a system where everybody.
What's the implied subsidy here?
Because the market interest rates that you are getting for taking any duration risk in the country is different for different segments of investors.
So Omo Bills is like an implied
So
subsidy. basically.
Omo is paying 26, 27, 28, 29% depending on the rates and the duration, right? And NTB is paying
23.
Is it 23 now?
Yeah, 22, 23.
It's
yeah.
gonna be
23. It's gone up a bit. So it's
True
gone up a
yield?
bit because it was at 19
Yield,
at
23
some
is yield,
point.
23 is yield.
It was at 19 at some
Yeah, it's
point when
gone
I
up a
checked.
bit.
It's
Yeah,
gone
yeah,
up a
it
bit.
went down to 19, yeah, it's about 23.
It was at
now.
19 at some point.
Yeah.
So that delta, right, in my mind, affects money transmission,
100%.
right?
Yeah.
So you either need to come to a world, right, where you basically take foreigners out of the Omo market, but that will create a massive liquidity pressure and will depress the yield curve. Or you might need to allow Omo as an instrument to be accessible to all class of investors so that the CBN then becomes the marginal setter of interest rates, because DMO is not issuing paper. Like, net issuance this year from DMO is about 3-point-something trillion.
Yeah.
I understand they've done a couple of bilateral trades that have funded a huge part of the deficits for this year. And they've also told you in their medium-term economic framework that the bill issuance they did in 2024 was a one-off, and they are going to term out going forward, which means that the amount of supply for NTB is small.
That's- yeah.
So NTB cannot do the heavy lifting
Yeah.
to ensure that market interest rate closely ties up with where the central bank wants it.
On the fact that Nigeria is a weird place where mango has seasons. You know, it's weird, right?
No, we need to move from agri. Well, the current. I mean, in my mind, we still have very medieval agricultural sector. Right? I think
No,
if
you
you look
travel
at,
to
I think the Romans have done a better job on agriculture than we have.
No, but you travel to some parts of Europe.
Irrigation.
When I say
And
Romans,
you
I'm
buy-
talking about
you buy
ancient
you
Rome.
buy
not-
mango.
not-
You buy mango, and you
Italians.
realize that they do not have mango is not indigenous to that country, and you buy mango all year round in that country, and you're wondering how.
Season over rich. That's what they tell you.
It's never plantain
No,
season.
but there needs to be investment in agricultural extension services.
Yeah.
There's massive investment in infrastructure that is going on, and
Yeah.
that will, and that, and
So
that,
that-
and
I mean,
that
I
will
hope this
come,
all
right?
feeds into inflation.
But I don't. So I don't know what the thinking is, and I'm not close enough to access to offer an opinion or stuff. But from what I know, doing my desktop work is access the bank needs 100% attention from the people running it. Right?
Yeah.
You don't want to be because like
Aren't they
that.
having that? I mean,
It needs to focus on growing its core income for the balance sheet that it has, right?
Yeah.
Like
It's not doing enough.
just looking at the core income,
Yeah.
strip out all the one-off derivative, all the other stuff that comes through. Like when I look at basically the core earnings of the bank, it's underperforming its balance sheet potential. So there's a lot of work that needs to be done.
17 banking subsidiaries. That's what they have.
Yes.
That's
So
incredibly
so
large.
they need to focus on that. So maybe Roosevelt, I don't know, has said, you know what, I don't need getting distracted by what's their fintech company again, O2 or Oxygen.
Oxygen.
Yeah. I don't need to be distracted by any pension. I said, let me just focus. I don't
Is it? There's a hydrogen now.
hydrogen is their own, not oxygen, hydrogen. And let me just focus. let me just focus on the bank. We've just raised capital, right? My shareholders are going to put me under a lot of pressure to ensure that I need to do what I need to do. The bank is fixable, right? But
Doesn't it a fix?
pardon?
Doesn't it a fix?
You are dragging words out of my mouth.
You said fixable.
So in terms
Doesn't it a
of
fix?
ensuring that it produces numbers in line with
it's
its balance sheet
exactly.
capital.
Okay,
Yeah.
sweating his
Right.
assets better.
He needs to sweat his asset better. All right.
Okay.
When you compare it to the likes of GT or
Zenith.
even to the likes of Zenith,
Yeah.
it's really underperforming in terms of core earnings growth and
Yeah.
by extension, earnings and distribution, right? So there's work that needs to be done there. And I think they wouldn't shy from the fact that that work needs to be done. And you've just collected money from your shareholders. You need to be able to justify that. Where the MD is not in the board at the time when I invested, I don't really think I'll care.
Okay.
However, for someone who was already at the board, sort of looking like being downgraded to go and just focus on your day job, I would ask questions, right? Again, I don't think we have enough information to
be
able to make a
difference
decision.
one way or the other.
Of what
Right? He's not leaving the bank, right?
Yeah.
And so if he was leaving the bank, then maybe you say that he's the new king of the castle, basically flexing his muscles and ensuring that he has his
His guys
people,
on, yeah.
right? Which will be fair, to be honest. But I saw the news. I actually didn't even raise an eyebrow. I just thought interesting and then moved on. Producer price inflation and consumer price inflation. So producer price inflation is what the manufacturer has experienced. Consumer price inflation is what the consumer experienced. That spread is expanding, and that is why you are seeing margin expansion across the board.
I thought it was price that was driving that.
It's not just price. Price is driving it, but margin is also expanding because your COGS is declining. If you look at your COGS on a nominal basis,
Cost is cost of goods sold.
cost of goods. So if you look
That
at
one
your
you can see
COGS
the-
on
you
a
can see
nominal
COGS year-on-year
basis,
going down.
you can see the
Yeah,
direction.
100%.
So
you can.
that's why you are seeing this margin repair. And this margin repair is you need like probably 8 quarters of growth for margin to finally stabilize before growth volume start to drive performance.
For weeks. I think I've been leaving the office at 10 p.m. pretty much every day.
So you're even the one losing.
And the reason is, in this business, you learn a lot of rules and heuristics and stories and narratives that kind of guide your decision making. So asset price behavior in times of strength, in times of stress, you expect that the US treasuries will rally, the dollar will strengthen, so the Swiss francs will strengthen, gold will strengthen. So those rules have been broken, right? So as a consequence, I have tried to go back to understand things from first principle. And one of the things that I was asking my team is, what are the rules? What are the narratives that has governed the global economy over the last 70 to 80 years? And it boils down to, I think, probably 3 things. One is that the US dollar gives you, and obviously the instruments you can buy with the US dollar, like the US Treasury bills, in some cases US equity, gives you instant fungibility, right? Which is why countries have basically accumulated a lot of it. Because what that currency allows you to do is that it allows you to, in a efficient way, store value that you can then convert into tangibles, commodities, oil in an instant, which is why we had a global system where the global reserve currency was the dollar. And the reason why we all behaved and we used the global reserve currency is that we believed in this sort of total fungibility, right? The first assault on that was the Russian-Ukraine crisis, when the US and Western allies pulled Russia out of the SWIFT system. The consequence of that was obviously people and countries realizing that this currency is not as dependable as we think it is. The offshoot of that was Mr. Arnold's favorite trade, which was the gold trade, because I needed an asset where I don't have counterparty risk, right? And so the gold rally happened from 2020, 22. And then the second is the US could always be relied upon as the naval police system, right? And also the US, while it's a global superpower, will act in some sort of benevolent way. So those are sort of the three wild assumptions that have underpinned global capitalism and global trade over the last 7-8 decades. We are seeing each one of those things unwind. One, it is quite clear that the dollar and the utility and the fungibility that the dollar gives you cannot be taken at face value anymore. It's now been clear that the almighty US Navy cannot protect naval shipping routes. And it's now clear that the US is not a benevolent actor. Right? So those three assumptions are broken, which means that we need a comprehensive reassessment of what the new world is going to look like, right? And as a consequence, the asset class implications of that. I don't have the answer, but I think we have seen a fundamental shift in the stories that we tell that underpins human behavior. So at the heart of what we are dealing with is not just economics, it's sociology, it's philosophy, it's these narratives that are. So in my mind, this war is a fundamental shift in alignment, is a fundamental shift in belief system. And these non-objective realities that we tell ourselves and we collectively believe is a disintegration of that non-objective realities in real time. So I think the world has changed in a fundamental way. And I don't think we are ever going to go back to a world that looks like 27th of February. 30 years, right? The world has recovered very rapidly from exogenous shocks, right? COVID, subprime,
crisis,
Greece. And the reason why is that the world has been in a deflationary direction ever since China got into the WTO. Right? Okay. We have struggled, especially in the Western Hemisphere, to create inflation. So when you get hit with that exogenous shock, you have significant level of monetary and fiscal response, right? That absorbs that shock. This time around, and I don't want to say this time is different because that's the scariest phrase in finance, right? But this time around, you have an inflationary direction that is moving against you. I'll put it in context. The US CPI is gasoline prices is 3% of the US CPI basket. It's gone up by 30%, 35% over the course of 1 month. That alone is going to add 1 percentage point on CPI on a March basis. That is before you factor in the flow-through effect on transport inflation and the other inflationary impact. So I won't be surprised that within that context, inflation prints at 3.5, 4% for March. 4%. Right? that happens, that completely neuters the monetary response. On the fiscal side, the US is running 8% fiscal deficit with very limited fiscal space at a time where countries who generate surplus and recycles that capital back into the US are needing capital at home. Right? So when you actually look at the global economic construct, you don't have the monetary space, you don't have the fiscal headroom to be able to absorb the shock that is coming from the supply chain and the energy crisis disruption. And it's why I think the market is incredibly complacent. And I think things need to get a lot worse before they potentially get better.
No, worse already. or just
sense, right? To be, I mean, one of the things the market hates the most is uncertainty, right? And I think uncertainty is probably at the highest level at the moment, right? And the only challenge is that in the past, when we were uncertain, we sort of had heuristics around how we behave. This time around, we are paralyzed, right? Because we don't know.
The past is gone and gone forever. Let's forget it.
Yeah,
we are now dealing with leaders who have, for want of a better word, have major personality disorders, right?
Can I touch on something quickly? So I do agree around the opportunity set that this creates for the country. I mean, when you have existed within a rules-based system that hasn't really benefited you as a continent, seeing the rules getting changed can only create an opportunity. Yes. But in itself, that also creates significant level of risk. So I don't worry about Nigeria from an economic perspective. I do worry, but the degree of worry isn't high. My real concern is when you live in a might makes right world, right? What guarantee do we have as a sovereign who is struggling to deal with a security issue in the north, has tried to deal with Boko Haram and has not succeeded, right? And we have these valuable resources that in a multipolar world is going to be needed. What stops the gunboats landing at the Atlantic and basically rewriting the rules that govern sovereign Nigeria? And as a result, as a consequence,
what do you mean by gunboats? What Venezuela-ish?
No, that pirates can come in and take you over.
The challenge you have is, like, we don't have a track record, and we don't have a track record around the effective management of fiscal windfall. What you likely would see, right, is if we have a very strong terms of trade benefit, is that it filters into positive currency effect, right? Which results in which results in lack of competitiveness, and then our import bill balloons, and then we go back and reset and have the same balance of payment crisis that we just got out of. I think that is the likely part. Obviously, there's a better part, right? Which that would require a lot of effort on the part of policymaker and the part of decision makers to take us down that path. Right. But my base case is that we will have a boom,
do what we always do,
and then they will do what we always do, and we waste it, and then we reset again. If I put the tax wedge today, would you pay the PMS at those prices? Would you pay at the pump? Right, because right now it's probably like close to $2 per liter to buy PMS in the UK. Would you pay that price today in Nigeria?
No.
Are we not? We're doing it.
No. About 70 or 80 cents.
Yes.
In Cameroon and Ghana, they are buying it at $1.50, $1.60.
Point in the other one of the other episodes that when you think about the Nigerian budget, we ignore the headline number. What tends to happen in Nigeria, and go and look at the data, is a deficit is communicated to the House of Assembly. That money is raised by the DMO. And usually, unless there's a supplementary budget, that money doesn't change. So when you think about total government, federal government expenditure, how do you think about it? You basically say the past budget deficit plus whatever fiscal revenues we can raise. That's usually what the budget is, right? And the plug figure that adjusts for that is the CapEx implementation, right? This time around, the only difference is that your fiscal impulse on the revenue side is likely going to be positive because of the oil windfall.
Anticipated oil infall.
Well,
Yeah, the quantum is so big
you've had
that
1
it
month
has to
of
be
it.
positive.
You've had 1 month of it already.
So I mean, last factor of anyway.
On it, again, tops in markets are notoriously difficult to predict.
Yeah.
Right? What I just try and do is when the probability is high that market is close to a
To the
top,
top. Yeah.
then you want to start dialing back on risk or at least taking hedged positions.
Yeah.
So
Right.
So in your view, is the probability high now that we are close to the top?
Yes, I think so. Unless, because so what could happen, right, is we top out, data continue to disappoint, and then Trump goes on a massive deficit spending, and then and then we get a new Fed, and currencies ease. So you might see the reflation basically get kick-started. But what that would happen is that it might keep the equity market okay, but I think capital will flow out of the US en masse, or people will hedge their dollar exposure, and the rest of the world should do well. Remember, my team this year has been the rest of the world will outperform the US market, right? And that's what has been happening. So US market has gone up, but if you look at it in dollar terms, relative to the rest of the market, I think capital has left the US and is going into the rest of the world. And I think that trend would likely continue.
Okay, how you doing?
It's been a really difficult 3 weeks. Obviously, I was very close to not confirming today when Arnold reached out. I mean, for the audience sake, we lost the third partner in the company, Dami, who is also a very close family friend, and it's been a very difficult time. She was our director of operations and finance, basically the backbone. We're just traders and investors, myself and Shola. So it's been a big blow. But I got back in the office on Monday, so I'm slowly getting into the hang of things. And I thought to myself when Arnold reached out that what would she want, right? And I think she was very supportive of our need to improve the economic conversation in the country and very supportive of what I do here. So I thought that in order to honor our legacy, I should make myself present, especially given that this is the first conversation for the year.
Thank you so much, man. Thank you so much. And I mean, I know it's not easy. Our condolences to you, to Shola, and to the family. I know how difficult things like this can be.
So I'll approach this from two perspectives. The first is this is the end of the rule-based international order. And this has underwritten peace and stability, at least in the western part of civilization, right? And increasingly China. So all bets are off, right? And as a result, the right approach, if you are a sovereign country, right, is basically to double down on your security apparatus. Because we are now back to gunboat diplomacy type of scenario, so 1800s, right? So this, in my mind, this has set us back to pre 1990s, pre World War II, right? Or pre World War One. So that's one. The second for me is increasingly, I think we're starting to see evidence of a tripolar world being formed, right? And what I mean by that is, in the past, you had the unipolar US that basically globalized supply chains and benefited quite significantly from that globalization of supply chain. And increasingly, Western industrial capacity were shipped east, right? What we are now seeing, driven by politics and driven by Trump, is we're now moving into a world that is going to be dominated by regional powers. And America, trying to bully China and didn't succeed, is beginning to realize that it needs to integrate itself into its spheres of influence. And as a result, would attempt to dominate the whole Americas. Just like I think China would attempt to dominate the whole of Asia. And then in Europe, it's going to be a tug of war between the Russians and what the Europeans are going to do.
I think the Europeans are probably the most freaked out from this, right? Because they've relied for a long time on the US security umbrella, which cannot be relied on
Anymore.
So what you are going to see is significant ramp up of defense capability on the European continent. Germany, UK, France, they must be shitting on their pants. So this is big. What does that mean for implications of markets, right? What does that mean for outlook? This is more longer term than 2026. But I think in order for you to have this sort of regional dominance play as opposed to a unipolar dominance, it means that you are creating multiple supply chains. It means that you have to industrialize around your ecosystem. So these have long-term effects on inflation, right? These have long-term effects on commodity prices. So what we are going to see, in my opinion, as we go through probably the next decade or the next decade and a half, is that you are going to see rapid amount of industrial spend as people begin to create this sort of tripolar war. The US can't defend Taiwan.
What's
I think
going to
they will.
happen?
They can't. They can't.
I'm not saying they can't.
They can't defend Taiwan.
I think they will.
It's
I think
it's
they
maths.
will try.
I think they
7,000
can militarily.
7,000 miles versus 180 kilometers.
I think-
war is about supply chain. Like they can't.
And so why hasn't China done it so far?
Because we've all been pretending that we are following certain rules. Nobody wants to be a pariah. Everybody wants to be able to go to the UN and hug everybody and say that we are behaving properly. That thing, that
is
that,
the
that
US
is gone.
is the US willing to let go of semiconductors? Because that's the reason why they're in Taiwan. So the semiconductor supply. Right, and that is what fuels
very chilling- it's a very chilling-
I mean, these are like crazy conversations
these are
that
like
I didn't think
No,
we
but these
would
are
be
conversations
having.
that we should be having because I think China Taiwan has been
Nobody
reeling
thought
for the
that.
past.
Did you think coming into this year? Did you think Trump was going to go into Venezuela?
I had
So the point I want to make is when you really look at fiscal impulse, right? And I'm very like I look at rate of change of things, not absolute levels of where they are, right? So, and that's why like I actually think the 2026 expenditure is going to have a positive fiscal impulse. What do I mean by that? It's the rate of change of the actual amount of money that gets spent, right? So I think the actual amount of money that will be spent in 2026, right, even though the budget are close to each other, is going to be more in 2026 than in 2025.
Where is that revenue going to come from?
Where's that?
Well, we've already said that they're going to have to do some level of fiscal dominance. So
Which, by the way, is borrowing.
that's why I ask you people, where will the money come from? Because Kaduso is not going to do ways and means.
No, of course
right?
not.
So at the end of the day, you then have to look at the growth in investments. So there's a level of investment income that is coming from the high interest rate environment that has to be reinvested. So that will fund some of it. And then the natural inflows into the pension fund, which is not very high in terms of, so investment income plus new growth, would that be enough to basically roll over the existing debt that is coming in 2026?
I think the assumption is that
and
you
then
should-
add
and then
another
add
17, which is
17,
why
yeah.
when I said this, I said they are going to do less than that. I actually think actual deficit at the end of the year is going to be between 14 and 15 trillion. I don't think unless something happens, right, or maybe externally, but to raise that money domestically, I don't think the capacity is there.
It's not there.
I don't think it's there.
All right, so you got it there for fiscal for the fiscals. The gang believes that we're not going to do anything close to 20 trillion in fiscal deficit, and even if we do, we're not even going to be able to finance it. So probably won't be able to do that because they want to raise 14 trillion in domestic borrowing, and they probably will get away with 3.5 trillion in foreign borrowing. But
If they do that, they will. If they are able to successfully raise that size, they could destabilize the macro recovery.
you think so? I mean, but rates are expected.
They
to go
stabilize.
down,
I think
so
if they can raise that size,
rates are going down.
Yeah, because
money supply.
you have to link everything together, right?
But money supply 120 trillion. Rates are expected to come down.
Yeah,
but
but
rates,
so
they will go
the
down.
beauty
They
of
need to
rates
make sure the
coming
rates-
down, right? So
Is this cheaper for them?
So I look at things from a risk premium perspective. We need Nigerian risk premium to take a step change lower.
Yeah.
And we have the macro framework that would enable us do that. The only thing that will spoil it is excessive fiscal spend.
Because they need to make it attractive.
Fiscal spend or fiscal
borrowing.
Borrowing.
Yeah.
You can spend what you want to spend for fiscal borrowing.
Yeah.
Because the market needs to believe that the short-term interest rate has anchored inflation expectation to reprice the entire curve and reprice equity assets. It is at that point you really have macro stability. I don't know if that makes sense.
It does, but
Reports that looked at inflation, drivers of inflation over the last since 1970. In Nigeria. Proper regression analysis trying to find out what the drivers of inflation is. I think Cardinal Stone cited it in one of their reports recently. 50% of inflation is driven by money supply. 50, right? 25% is driven by the exchange rate. And the other 25% is structural, right?
we've been trying to hear what Zeal's view on this, because Zeal and I had this discussion. I'm not sure this was anyway. Go on.
But this is the IMF report. This is not me. I'm not the one that did the analysis. But this is like they went 50 years data and that kind of stuff. And to be honest, if you plot money supply growth and you plot inflation, the R square is very tight.
I can imagine because I know what the chart of money supply looks like. So I can imagine.
So money supply has gone. I think as at 2023, we're doing M3 growth of like almost 80 to 90%, right? I think last year, we'll track money supply at around 15-16%, right? So when you really think about it, money supply is now growing slower than nominal GDP. That's massively contractionary, right? I should have an impact on inflation.
Started earlier
So
than
election spending will drive up inflation, eh?
So there's no evidence of that.
That's what I was
by
about
the
to
way.
ask.
The data doesn't show that.
I think it's assumption.
It's an assumption
That's
that
corroborated.
We
all assume that.
So there are elements of consumption that election spikes, media spend, advertising,
Yeah, but that's not
logistics.
Yeah,
But when you
yeah.
look at the weight relative to the total
economy,
basket,
No,
honestly, like food is 60 to 90% of people's wallets, right? So if you can get food right, I think you get your inflation core right. And then you go to everything that feeds into food, money supply growth, exchange rate, and those things. But if you get food right, and harvest has been good, but I think it will start to lean. The only point I want to make is, because I've been hearing a lot of commentary around inflation is going to spike to 32% in December. It's statistical. Right. Let's make it so that people don't panic.
Base effects
So it's
and
pure base
numbers
effect from
and
the way
all that,
debate. I'm hoping NBC comes up with a correction mechanism that
for
allows
that.
us to smooth that so that people don't panic. Right. The beauty is that from February, we will now be able to ignore completely all the noise. And they will now have real data to be tracking. So December inflation might surprise negatively. If the market decides to react negatively,
No, but I think everyone's expecting.
That's what I'm saying. So my view is you need lower cost of capital. So any friction, right, that distorts that cost of capital compression is something that I don't like. Which is why tinkering with the market and I don't want to be
already working.
I don't want to be the guy. I don't want to be the guy that is always anti-regulation, because obviously CGT I had a position, now I'm having. So that's not the idea. The idea is that we are midwifing this new market, because the market was dead for a long time. Suddenly the market has signs of life, right? And I feel like we are overthinkering and giving people a reason not to bother. Right. Remember, like Nigeria is not a big market. It's not in a big index. It's in a standalone index. So frankly, people don't have to look at it. Right. Why make it more difficult for the people who want to look at it to look at it? So when you are saying product issue, plumbing issue, see, if that infrastructure doesn't exist for you to be able to do this, that means the plumbing is not working. It's not working.
No. It's the same way. It had not needed to pass. No, it had not needed to pass.
In a perfect world,
it's the same
it's called
way.
a pension
It's the
fund that
same
has
way.
lots of stocks and be able to borrow from the pension fund and then short it.
Somebody should create a product. It's my
Jeez,
problem
man,
now.
you guys just complain.
Somebody should create a product.
That's the problem.
I think we are detracting here.
Yeah.
Because it's again, like when we say plumbing, is the ease at which you can carry out the transaction.
Absolutely.
And the ease at which the
I agree
transactions
with you.
are frictionless,
Yes,
right?
yes.
What I'm saying is that what we are describing here in terms of issues around time zones, in terms of the process around global settlement, instructing local settlement, in terms of FX market, in terms of ensuring that you have a very limited room. You can't correct issues when they happen.
Yes.
So that's in order for you to be able to fix that, right? You really need to rework the engineering of how trade is settled.
Yes.
And how, so, for example, like in order to get your local bank to pre-fund your trades for you, right? Come on, at the moment, the no free is 22-23%.
So how are you going to price that into your stock? So you have to price that cost. You have to price it in.
Finish. You know why it's upsetting?
That's the thing,
Finish. You
oh.
get 5 minutes.
That's what I face, my brother. That's what I face every day.
No, man, that is the cost of no free. So it's
I agree.
Because see, do you guys want solutions or you guys want problems? Because I have a lot of
agree
problems.
with all these things.
We can spend the whole day here talking about problems. Daily says they don't.
I spent no. See,
says they don't understand.
I spent almost 2 decades of my life.
Yeah.
Of which about 15 years of that were covering this type of people.
Yeah.
Right. And I've tried, like most of my career, to bring foreign capital into Nigeria. That was my first job before I started Rosk.
Yeah.
So in a way, I understand how these people's minds are wired. Right. Nigeria, unfortunately, is not China. Nigeria, unfortunately, is not South Korea. Nigeria, unfortunately, is not Brazil. As a broker, Dele can give you testament. As a Nigerian broker, right, you are even lucky to be able to talk to your client when he's walking out of his meeting between one meeting to the other. He doesn't give you 1 hour to sit down to come and talk about the benefits of why you should invest in Nigeria, etc., etc. So when you first of all go and sit down and say Nigeria is interesting, it is going through a lot of these reforms, and you manage to get his attention, right? And then he now say, okay, this is interesting, let me trade. And then it's considered and say, oh, by the way, you can't trade unless you pre-fund. The guy doesn't care. He moves on to the next thing.
Give you time to fix whatever teething issues you want.
Can I say 2 things?
You guys said it here today. Between now and September, we're not getting back into all these indexes anyway.
So no, we're not
getting there. So why? This is like a storm in the teacup to me.
No,
and that's my point.
It's not a storm in the teacup. Equity markets, prices are set at the margin. You cannot make the argument that because 80% of the market is one class of investors, we should ignore and not cut out because
I didn't say ignore. So why are you ignoring? Why do you want to ignore the 80 then?
I didn't say ignore.
The 80 wants it. The 80 wants T plus 1.
Can I finish? Yeah. So it gets the price. The marginal buyer of an equity or the marginal seller of an equity it's what drives the price.
Yes.
So as a consequence, you need to ensure that the pool of investors are decent. So that's point 1, right? That I want to make. The second point, right? That I want to. Sorry, I've lost my train of thought. But the second point. So that's the first point that I want to make around the fact that you have to look at the entirety of the pool of investors. The second point I want to make is you don't create policy on what the market is today. You create policy on what an ideal market should look like, right? Or having a decent mix.
What's global best practice?
Well, having a decent mix of local institutions, retail investors, and foreign investors is probably the perfect mix that you should have. So your policy formation should be driven by an idealized idea of what you want your market participant should to look like, right? So you can't say, oh, because foreign investors, local investors have been the one that have driven the market, right? And at the margin, what you are offering, in my opinion, what you are offering local investors by providing 1 day of faster settlement, right? The problems you create at the margin for the foreign investors, in my opinion, is much larger than the extra 1 day instant settlement that you give.
I don't agree though. I think Tunji captured it clearly.
So this is the part, I'm wondering, because this is not speculative. We know the brokers that intermediate most of the foreign business. It's Stanbic, it's Cardinal Stone, it's Chapel Hill, it's CSL, right? You go and speak to them, right? And I've spoken to some of them today because trying to understand the dynamics, because it's very important to me as a local investor, right? And they're like, okay, volumes are down, right? Global custodians are suspending settlements in Nigeria, right? Is it permanent, or are they trying to rework their plumbing to ensure that they can live with this reality? Is yet to be seen, right? And investors are just like, you know what, I will hold off until I have clarity on how this new system works. The point that I'm saying is, and this is the part that, like, I think we're getting carried away here because the market is up in nominal terms.
No, I don't think that's the thing.
And we think that because of that, the market is hot. So what we have experienced in Nigeria is a nominal reset of asset valuation.
Yes.
Nigeria is not in a bubble, right?
Yeah.
The valuations are still cheap. Nigeria
But,
is trading on a trailing PE of 10 times. That is a discount to Frontier, and that is a discount to EM. So I don't want to.
What you're missing is sentiments. I think there's a lot of positive sentiments around interest, sentiments and interest.
Again,
and I think that
again,
counts.
you want to feed that positive sentiment and interest, and you want to get your deep pool of investors, right, to be able to participate. Guys, if Dangote wants to, if somebody wants to raise 2 billion, it's not a Yabasira that is investing 100K in the market that is going to make that happen.
I don't. You know me, I'll fight you when you say things like that. But the core is simple.
Retail has a role to play in the market, but deep institutional capital market has to have deep local and foreign investors.
Let's be clear.
When you look at the equity markets, right, there are a lot of reforms that we need to carry on, and some of the capital market master plan has some of them that are credible, right? So, for example, we don't really our market is. It's sad to say, but it's not. Price formation in this market is not functional, right? You have an equity free float requirement that it's almost a suggestion. It's not real. So everybody have different free floats. So the price discovery mechanism in the market is not working. You have the 100K rule, right? That creates stale prices, right?
Yeah,
so you have companies like Geregu or companies even like Seplat, like Nestle, that in order to move the shares, you need to 100K shares have to change hands. So the real price you are seeing on the screen is not real, right? And then you have this plus
100 shares or 100,000 shares.
100,000 shares, yeah. So you have also this plus or minus 10 over the last day period that creates artificial. There are a lot of.
So there are other things that need to be worked on, not.
And then there's the issue around shares. There's an issue around unblocking shares. So I'll give you an example. Right. In order for me to sell my position, right, I use a custodian, right? And in order for me to sell my position, I have to basically tell my broker to release the shares that I want to sell. I've passed information to that broker. So oftentimes what happens is that once my share gets released, my price starts to move against me. Yeah. And that was created in the days where assets were held by brokers. So one of the reasons why that rule was put in place was to ensure that brokers don't sell assets without the knowledge of the asset owners. Now, most of the markets is not there, and you then have CSCS that is now the central custodian of this asset. So that rule of unblocking, in my mind, is redundant. And if anything, if you really want to keep that, there's a technology script that you can write. I can tell a broker, sell me 100K MTN. He can enter 100K into MTN into my account. If I have the shares, it should say automatically I have the shares. If I don't have the shares, I don't have the shares. Why do I, if I want to sell 5 million shares, I know that if I don't have it released, I can't trade it. And the moment I tell a broker that I want to sell 5 million shares, the broker knows that Samson has 5 million shares in MTN, the stocks has to go down. Right? So that is information leakage. That is a market reform that needs to be fixed. There's also the nasty issue of insider trading in this market. Right? Where oftentimes, go and look at it, before numbers come out, the market has seen it. Most of the time, MTN, for example, they wanted to report a week before the numbers come out. WAPCO is a classic example. You see the trades happen before the results come out. This is leakages. These are areas that if you really want to create a highly functional equity market, which is something that we should all work towards and we should be very proud of, a market that people trust.
But can't you trigger my work at the same time?
There's a hierarchy of reforms that we need to perform. T+1 is in a list there. Is it number one? No. Or is it number two?
Who determines what's number one or two? You?
The highest impact that it has.
Why doesn't it have impact? Why doesn't instant? Why is instant settlement not important to you?
So there's also the other issue.
How? I don't get
the cost of actually trading these markets.
Oh yes, I agree on that one too.
Right. So for me, I'm an institutional investor, so I have pricing power. Right. So I squeeze my brokers as much as possible, even with my pricing power. To do a round trip in Nigeria is 1.5, 1.6, 1.7% per stock. And guess what? A retail investor is paying 3.5%.
Half of that is going to the regulator, right? And then Ogojo will not be sit down here and say that broker does not have app. What do you want to have app? Because
so the ones that have app, where are they getting?
Hold on, something is squeezing his broker
because there is zero fees.
Zero fees. It's mad.
Squeezing my broker. That's the only margin I can squeeze.
You're in industry.
Yes, that's the only margin I can squeeze. There are often degrees of how much it affects you.
And when I look at how the distribution of pain from the Strait of Hormuz crisis is, I think obviously the South Asian economies like Japan, the Philippines, the Pakistan, that have very thin inventory buffers are feeling the most pinch. Obviously Europe, with its crazy climate euphoria, has decommissioned a lot of its dirty power, and even in some cases nuclear energy in Germany, and has become very vulnerable. While the US is self-sufficient from a availability standpoint, the oil market itself is a globalized market. So they are also feeling the pinch from the change in the pricing, right? But so my order of pain is Asian economies and India, Europe, right there, and then the US that are feeling the shocks from the increase in energy. But a certain part of the economy is benefiting from it, which is the Texas economy, oil-related, the Permian Basin, and all those shale producers. China, on the other hand, has done something remarkable. When Trump 1.0 happened, and the tariffs were put on China and the semiconductor bans were put on China, China realized very quickly that it needs to do something about its vulnerabilities. And if you look at the data, while everyone was talking about a real estate crash in China and a consumption crash in China, I look at banking data and people were talking about a potential banking crisis in China. What was happening wasn't a crisis, because when you have a banking crisis, what happens is risk asset accelerates and loan growth shrinks. The opposite was happening in China. While loans to real estate sectors were declining, loans to industrial sectors were accelerating. So what was happening? China identified a few things. Number one, it needed to be as energy self-sufficient as possible. So it invested significantly in solar, invested significantly in wind, invested significantly in nuclear, right? That right now, its energy, the oil and gas portion of its total energy mix has fallen to sub 18%. And that 18% is not direct energy, it is even petrochemicals. So it's a lot more insulated. In addition to that, China has invested in storage capacity. Official numbers is that they have about 2 billion barrels of storage capacity for crude. And official estimates are about 1.5 billion of that storage. They have 1.5 billion of crude available. Unofficial numbers are saying it's between 1.7 and 1.8. That is more crude reserves than the rest of the OECD economies combined, right? The same with natural gas. The same. So China has significantly reduced its vulnerabilities, which is why when Trump attempted to do Tariff 2.0, it had more levers to pull, and it could impose the rare earth ban, which suddenly the US realized that machines in GE factories will not work. Missile technology will not work. Lots of inputs that require rare earths will not work. So back to Tosin's point, it sounds like you have an adversary that suddenly you realize you have to respect, right? And it's interesting that over the next 12 months, Trump and Xi are scheduled to meet 4 times. It's never happened in Chinese history. So that's the respect that China has earned by strategic decisions that it's made. It feels like it's the only adult in the room in all this mess.
Capable of
right?
And coming from someone like Trump, who is,
Trump in my mind is like, like you have this guy in class, right? That everybody thinks is the biggest guy. That guy will just be shouting for everybody. Then suddenly there's this guy that is skinny but very tough. Suddenly punches this big guy in the face. The big guy. And then suddenly everybody is like, this big guy is not as powerful as we thought he was. He's still powerful. He's not as powerful as we thought he was. So and then obviously, so my point is, the conversations is going to be had at a more even keel. What does victory look like for Trump? Obviously, the expectation is that China holds significant level of leverage over the Iranians because they are the buyers of Iranian crude. So for Trump, success will be any way for Xi to bring the Iranians back to the table to have a deal to get the Strait of Hormuz opened. I don't think the guy wants to fight anymore. He wants to open the Strait of Hormuz and tell the rest of the world, whatever problem you have in Iran is your own. I've opened it. Figure it out, right? So, but China knows that it has that leverage. So the question is, what will China extract, right? From that. Because China can do that, given its influence. This is why we have to watch what happens with conversations around Taiwan.
Interesting.
Yeah, that's interesting.
US, I think the US was significantly weaker prior to.
America cannot move its destroyers to anywhere within 1,000 meters of Iran, which is a country that was economically on its knees and had very, on paper, weak military infrastructure. This is a game changer. I don't think we understand, like, the idea that in order for you to be able to have military superiority, you need to control the skies. And the way to control the skies is by getting large destroyers, aircraft carriers next to the countries you want to attack and sending F-35s into the air. That way you are controlling the country. That is a myth. China and Iran has shattered that myth. Iran has basically turned asymmetric warfare on its head.
Was it Iran that shattered this myth, or was it Ukraine?
Ukraine started it, but so now this concept, right, that you can dominate a country by superior air power alone is no longer true. It's no longer valid. You are right now being driven out of the Middle East, and you're telling me they don't have the
No. So the Iranian conflict itself. The Iranian conflict.
They were dragged into it by the Israelis.
That's my point now.
But by dragging into it by the Israelis, they are proving to the rest of the world that they are a lot more vulnerable than people think. Who would have thought, right, that Iran will hold the Strait of Hormuz and America cannot do anything about it? Like, if you told me this a year ago, I would have told you.
Is it they will not do? They cannot do.
In order for them to do something about it, they need to be willing to commit resources, and people need to die. But America is not prepared to. Markets are forward-looking. Earnings are backward-looking. So to the extent that earnings report gives you confidence about future earnings, then markets should re-rate.
And the guidance after the earnings release.
So the challenge I'm having, Tosin, is why does America trade at 22 times earnings P, right? The American economy over the last 3 decades, since the global financial crisis, have created a capital light approach to earnings extraction, right? So as an equity guy, there are 2 things I don't joke with when I think about asset prices: growth and return on invested capital. Right? I try to capture both to know what valuations should be, right? America had a business model that allowed it to eke out growth with significantly low level of marginal capital commitment, which is why businesses like Amazon, businesses like Facebook traded at the multiple that they did historically. As a consequence of AI, the business models of these companies are shifting from asset-light businesses to significantly asset-heavy businesses.
But was Amazon really asset-light? Would you consider them asset-light businesses?
So over the years, they've actually invested largely on distribution. All right. So they are now reaping.
But they're expensing a lot of those distribution. It's not carried on the balance sheet, right? So they spend a lot of money, but look at the balance sheet.
No, they're still balance sheets. In terms of capital, they're still balance sheet heavy in terms of capital. But if you look at it,
relative to the money that is currently being spent on AI, that all this
relative to other hyperscalers,
Amazon is probably on the capital intensive portion of the capital light conversation. Netflix, for example, capital light. The point I was trying to make is the business models for these companies are shifting, and the return free cash flow for these businesses have disappeared. Even businesses like Facebook are now raising bonds in the bond market. People are now using debt to
So
fund
I guess your
capex.
point being rates.
Wait. I
You
come on,
was-
we'll go
I
through-
was-
Have you seen the one where they live in a rock?
No, that's what I'm saying. Like, what's the one we're living in? I don't understand.
My job here is to balance views. Right?
What was it?
Exactly. So balance views. So at what point do you say, look, is it getting irresponsible to continue to keep rates sticky or high when the entire
The
economy is also
Yeah.
is
Yeah. So the only leg that hasn't broken in our macro story yet is FX stability. If you threaten that thing,
But
we're
even
in
that
trouble.
stability is
Let
too
me
stable, though.
explain something.
Okay.
If March inflation 4% month on month, annualized is 48%. Let's be understanding the persistence of inflation that we are seeing. It's not that it was just food and energy alone because of the
Wasn't it just a
removal
short
of
term?
but the problem is that if you look through the data, the inflationary spike in the economy was very broad-based. It was not energy, it was not transport, it was accommodation. Core inflation accelerated. So you are seeing some level of persistence. On top of that, for April numbers, you are now entering into the lean season. We assume that during the pre-planting season, inflation in Nigeria, on average, looking at 30-year data, usually goes up to 2% month on month, just on a normalized basis. Right? So you are now in a situation where, yes, the impulse from the energy shock is receding, at the same time where the food impulse is also accelerating. Within the context of that, you have inflationary dynamics that is persistent and food inflation that is about to go up. Right? And then you are sitting on a situation whereby you have 34 trillion worth of OMO to roll over within the next 8 months. You want to risk pissing people off because you want to bring interest rate lower, and for a central bank that is taking its entire credibility around inflation targeting. The numbers don't tie up. I actually think personally, although I know it's non-consensus, I don't think they will hike rates because of the signaling effect. But there are quantity variables that could be adjusted for such as CRR.
You want to tighten it more?
So you expect them to
so,
tighten.
You want to tighten CRR more?
Or it depends on what they are solving for. CRR may be difficult to tighten
Yeah, there's
because
no
of
room.
the system. Because
Yeah,
some banks
there's no
will be
room.
able to tolerate it. Other banks might
Yeah,
have
yeah.
real difficulty. But obviously, if you look at the liquidity surge, there's so much liquidity sterilized in SDF.
Absolutely.
So much liquidity in SDF. So they might actually have a situation whereby they tighten the asymmetric corridor, which
Why
is
tighten again when there's so much liquidity surge in SDF?
because the SDF is acting as the marginal rate for the entire fixed income curve.
You know why? Because the SDF is the money that the banks have, right? And CBN is creating a window for them to place that money.
There, yes.
Yeah. In addition to what he said, M1, M2 have been on the rise and will continue to be on the rise.
For the last 5 years.
Exactly. And that is more money coming into the market. So depending on their mandate at the next meeting, if they perceive that inflation will still remain elevated, they will not touch that anchor rate at all. They can play around the asymmetric corridor and say, okay, what can we do?
Yeah.
That's number one. Number two, they need to continue to make the foreign guys happy.
Yeah.
By keeping it high.
Yeah.
Because
those guys, perhaps they are also responsible for the FX stability in this country.
Not perhaps.
They are responsible for the stability in this country.
I try as much as possible
To be
It will be exactly.
Yeah, I understand.
Yeah. Because again, don't forget that. Don't forget that again. Your external reserves on the rise, right? So perhaps maybe they have enough arsenal to defend.
External reserves have been declining systematically since this crisis started.
Exactly.
The challenge I am having, the challenge I'm having right now is that I am not
But we have
seeing
enough buffer.
buffers are fine, but the rate of change is negative.
Yeah.
You have to acknowledge. And the challenge I'm having is, I know Nigeria should benefit from positive fiscal impulse.
Yeah.
I've been tracking NNPC data. I've been tracking reserve accretion,
not
and I'm
working.
begging God, please
What's
let
going on
me
there?
see numbers go up so that we can start to exit this foreign portfolio investors.
But we can't.
But right now we cannot do that.
But we can't because
So
unfortunately,
this is why I'm a bit frustrated with Trump, right? Because
we were in a clear disinflationary path, right? We were seeing basically inflation trending to 1% month on month. 1% month on month annualized is 12-13% inflation exit, right? Within that environment, rates cross normalize, bank net interest margin comes under pressure. And in order for you to keep your multiple, you would have needed to basically do real lending.
So are you saying
Some
that is
started.
the only time you
So if
allow
look
that
at-
happen?
So if you look at Zenith now, in Q4, they basically lend 10% of their loan book. So annualize that to 40% year-on-year growth, right?
In a quarter, 10%.
10% in a
quarter.
quarter. So analyze that to 40% year-on-year growth. So we were starting to see the signals that loan growth was going to pick up.
Yeah.
But now Trump has now said rates are going to stay higher for longer. So banks' names are going to hold up. So the incentive to Shago said this really well. He was like, ultimately, my job as a bank is to optimize the yield on my interest earning assets. I have 3 asset class that I can lend to: my investment security books, bank placement, and my loan book. I need to ensure that I earn the right yield, risk adjusted return. Why will I lend to somebody at rates that are equivalent to my investment security books, and then I have to take capital charge and potential
100%
risk of
makes sense.
NPL down the line? It doesn't make any sense.
And
So,
general provisioning as well.
so you need to engineer. So your point of being left behind,
ultimately,
Tuji, is sentimental.
It's
and
not.
and it's
It
very,
is
it's very.
not.
So,
It is
so
not. It
guys,
is not.
I know there's been a value transfer
Yes.
from the consumer, right, to the government.
Very painful.
No, and it has been destructive, right? But the point I am saying is, in order for us to get out of this destructive part, there are certain decisions painful that we had to make. And we could go back and critique this government that the FX liberalization was not done and sequenced as well as it should have been. The excess that has come from the savings has not been deployed efficiently. There's a lot of things to beat this government about, no doubt about that, right? However, when you look at the decisions that have been made and the inevitability of the transfer of value, the other point, Tunji, I wanted to make, and this needs to be made very clear because people don't seem to understand. When I listen to people on the main streets, they tell you that when Tinubu came, FX was 750, right? And interest rates were lower. Today, and price of everything has gone up. Today, price of everything has gone up. But they don't realize that there is no way in the world they would have lived in a world today that was 750 FX rates, given the trajectory that we were on
be held
at
at
that part,
750.
because it could not be there.
Yeah.
So I know it's not easy for people to comprehend counterfactual arguments.
This is
idea
not
that this decision
no,
making
wait,
that
wait,
this
wait,
guy's
wait,
made.
No, you guys are trying to rewrite what I'm saying. My issue is not the economy. The macro is fine. That's not my argument.
Not the decision around the
My
macro.
issue is when it was fine, you said no, it's too early.
But it was never fine.
It was
though.
not fine, and we were just stabilizing.
But we
it was never
know
fine.
the
It was never
world for
fine.
what it
So
is.
would
That
you
the
have
world
accepted?
never gets to a point.
Would you have accepted a rapid interest rate decline that would have need to be accompanied by capital outflows and a rapid interest rate increase now?
No.
This is what I think. A huge part of Trump's political base is US evangelicals, right? And in my mind, some of these evangelicals are as radical as the Islamic extremists they tend to dislike and hate, right? And there is this group, and you can go online and you can read about it. There's this group of very ultra right-wing US evangelical people that are very obsessed with the concept of Armageddon, right? And they really think that there's going to be this big global war that is going to be fought with the Abrahamic religion. And that even underpins their support for something like Gaza, right? So, like, I think in the book of Revelation, there's this war that the Christians are going to apparently win, and then they're going to leave like 144 Jews, 12 from each tribes. And then after that war is won, then second coming of Christ, and Christ will come, right? So there are people that really believe in this extreme views, and people that are comfortable. If this world goes up in nuclear smoke, they will be happy and they'll be celebrating that Jesus Christ is coming. There's that people. Every religion has that side
Its
of
own
those
version,
type of extremists. The only challenge is that most of these extremists never really get close to power, right? A huge part of Trump's support, and that's why people call Trump the new David, right? He's not perfect, but he loves God and he's going to do God's bidding, right? And I think what this was basically a dog whistle to that base
to say, you know what, I care about Christians. I care about.
But Sam, that sounds simplistic, though. You sure? Because
See, I always apply Occam's razor to my analysis. The most simplest explanation is usually the right one.
Listen to Ted Cruz. I've been pushing legislation to designate Nigeria a CPC and to impose sanctions on the Nigerian officials responsible. So, legislation to designate Nigeria a CPC. Thank you for President Trump. Thank you to President Trump for his leadership in imposing the designation and more broadly for fighting to stop the murder of Christians in Nigeria. Now we should take the next step and hold Nigerian officials accountable. I intend to be very explicit about who they are in the coming days and weeks. Now, I go on again. This is now Hexat. The killing of innocent Christians in Nigeria and anywhere must end immediately. The Department of War is preparing for action. Either the Nigerian government protects Christians or we kill the Islamic terrorists who are committing this horrible act. So guys, so it's either this is just the new way of just yarning, just ranting online.
It's not ranting.
Or because if you read these things, there are a lot of actionable words here.
I'm not disputing that there. So again, Ted Cruz, where is his support base? Ted Cruz said on that interview with Tucker Carlson that he came into office to protect Israel. What is his business with Israel? Right? Basically, that's what he said. So these people have the very warped, and it's insane that these are the people that are in policy. But don't be surprised how that religious undertone drives a lot of these people's thinking. But let's not downplay the insecurity situation in Nigeria.
Of course.
And,
you can't downplay that.
And the fact, right, that two things. One is, I think the government needs to do a lot more than it's currently doing with insecurity. And two is, why the hell does Nigeria not have an ambassador to the US? Almost how many months since this new administration came in? So like so
is that where we missed it then? Because that's why I'm saying that's why I initially said maybe this.
It will.
Yeah.
If and this is what I don't know, and we're trying to run the numbers. If the local existing capacity is not sufficient to meet demand, it's a commodity. So it trades at the margin. The cost of the commodity
will likely rise.
Is the cost to supply the marginal product to fill the demand. So for example, if you have 100 liters of demand and you can fill 90 liters at 50, let's say for the sake of argument, that's $50, right? But 10 liters at $100. The way commodity pricing works is that it will be $100.
Yeah.
It will be the price for everybody. Will be $100.
Yeah.
Right. So because it's a commodity, the commodity usually prices at the margin. So I think they have to be confident, right, that local existing capacity is such that it will cover demand. Otherwise, they will have to be prepared to see price increase. No, we had more than 15% for cement. Yeah. We had like probably cement, there was a lot of things, right? He controlled the import logistics. Then there was import. I think when you put the gates was much higher. But again, see, I'm a big Dangote fan. And I have basically articulated my view around all the madness that was happening with Dapman and NMBPRA and all this stuff, right? However, 15% is a tax, right? In a consumer environment that has been completely bastardized, right? And if you make the argument that 60% of imported products is 60% of PMS is still imported, right? So you can run the numbers, 35 or 40 million liters a day times the $170, and you can basically model very quickly the hit to consumer pocket, right? That's going to be in a point where the consumer confidence is being restored, right? I just feel like that hit at this point in time seems to be a bit too premature, too early. Having said that, I'm a huge fan that Nigeria has to do whatever Nigeria needs to do to ensure that refining capacity, that refinery works from the perspective of, number one, like it's a core pillar of our industrial growth because of the adjacent industries that refinery is going to produce, right? But
I just feel, right, that that tariff is a bit too punitive at this point in time, given where we are in the macro cycle. And I'm suspecting what may also be happening is importers may be bringing in substandard products that undercut Dangote's pricing. And this is just a way to equalize that a bit. So,
but how many people are importing now, though?
If the market is still 60% import, then still a lot of people are importing. NMPC is importing. So what I would have expected, if the quality is the problem, then NNDPRA should do its job to ensure that the quality specifications that come into the country is right and Dangote is competitive. Putting a tax on the consumer, which is effectively what this is, at this point in time, right? Why I agree with the industrial strategy of ensuring Dangote works. I'm not sure.
Any impact on inflation?
It should have an impact on inflation, right? Naturally, like it should, because we've been seeing inflation stabilize, right? Actually, we've been seeing disinflation. So food inflation has gone down. Core inflation is stabilized, but it hasn't had the disinflation that food has had, right? And a huge part of core inflation stabilizing is that energy has been coming down, right? So if you are going to see energy go back up, right, I think at least from a monetary perspective, you will see a spike or a slowdown in the pace of inflation deceleration. And that has an impact on monetary policy. That has an impact of easing plans. So in my mind, I'm just like, and this is a challenge I've really had with this administration. While I have been a huge supporter of the tough decisions that this administration has made across monetary and fiscal, there is always a question around the way plans are being sequenced. Firstly, I think we got into this economic mess largely because we didn't sequence our reforms adequately. Right now, we are now showing green shoots of recovery, right? And it feels like some people think that just macroeconomic recovery alone is what is needed, right? Meanwhile, macroeconomic recovery is basically stabilizing the patient. You need to nurse the patient to health. You need to make the patient healthy so that the patient can now be running marathon. To get there, you need to trigger an investment cycle. You need to ensure that consumer confidence improve, consumer wage growth comes in. Those things require a bit of time. But in my mind, I'm just like, when I look at certain policies that are coming out, this 50% tax is one, this CGT on the capital market is another. And I'm like, while I understand the need to address fiscal concerns and those type of stuff, I just feel like that should not be the most pressing priority given our macro trajectory that we are on at the moment. And the risk, right, is that you stall a macro stability that we've worked so hard for to achieve.
On the altar of...
And on the altar of fiscal revenue.
Fiscal revenue.
Right. And that's what
But can you dislink them? Can you? Because, I mean, at the end of the day, huge part of macros are divided into monetary and fiscal. So as your monetary side start to improve, fiscal has got to join.
No, so again, so there's a part. So economy has been bastardized, right? We're in the macro recovery stage. As economic growth picks up, your fiscal revenues, right? Because obviously the non-oil part of fiscal revenues have been growing. So your fiscal revenues should also reflect that as well. And I think there's a lot that should be done with regards to increasing the tax penetration to GDP, right? Those things have to happen, right? But you can sequence them. For example, this CGT conversation, right? While I understand the fiscal priorities, right? The amount of money we are talking about in terms of that is going to be raised.
So it's not a lot compared to the amount that you lose.
The damage that you will cause. If you allow this market to evolve, you allow this market to develop, you create a system that basically redirects capital out of short-term OMO into equity instruments. And equity instruments is risk-bearing. And one of the points I really wanted to make, because I've seen a lot of articles and comments come around and say, well, the tax CGT reforms is such that it doesn't affect retail investors. It only affects institutional investors and foreign investors. The truth is that those are the big aggregators of capital. Both your local, the local asset management industry in Nigeria is what 6 trillion. Most of that money is sitting in money markets and fixed income securities. As rates come down,
cost of equity normalizes, there should be capital outflow out of these products going into equity assets. These are going to be intermediated by local asset managers. But you are now coming and saying, you know what, those local asset managers, the tax burden on them goes up, the cost basis of them of applying CGT is retroactive. The ability to decide when those things get cut off. So, for example, they're saying that if you use intermediary instruments while you liquidate one asset and you want to invest in another asset, it's a CGT event. Given how illiquid the market is difficult for an institutional investor of size to sell, let's say, a position in GT and immediately reinvest it in Zenith. You might need a bit of time. And over that period, right, you are also assessed as an institutional manager on what your return on cash is.
Yeah.
Right?
Yeah.
So
I think since you're here, Sam, let's discuss Fugas. There were some of them that had results delayed, and finally they're all out. We've seen Access fully out now, half year, 9 months. We've seen First Holdco, we've seen GT, we've seen Zenith, we've seen UBA. Just your general reading on the numbers that you've seen so far and what your takeaway is.
So,
maybe let me just rephrase the question so that we can kill two birds with a stone.
Yeah.
So you've seen the results in general. What will be your buy, sell, or hold for everything you've seen? What do you like about the result? It's a buy. What you don't like about what you've seen is to sell.
See, for me, like there are only 3 banks in Nigeria, right? And that's always a starting point.
And
for
what
me.
are they?
Maybe 3.5 now.
What are they?
Stanbic, GT, Zenith.
But Stanbic is not a Fugas.
It's not a Fugas, but I consider it a bank that feels like a bank to me.
Okay.
And so, like, it's GT, Zenith, Stanbic. Increasingly, where am I starting to look like a bank? But we can discuss that.
Okay.
So back to your question, that's my investment universe. I don't go outside of it. Okay. That's what I.
This is Sam.
He's something about to ask questions, so he just like
that's my investment. That's
for these two guys. What have you seen? What are the buy and sell?
So what have I seen? What are the trends? Right. Nominal earnings are down. Right, but the market seems to read that quite pessimistic.
Nominal earnings.
Right.
If you discount for FX.
No. That's why I said nominal. So if you look at headline EPS, 9 months 2025 or 9 months 2024, it looks like, earnings are down, right? And people are looking at that headline and saying, this is the end of the parties for the banks, right? Yeah. However, if you look at cash earnings, which is basically what the banks used to pay dividend, it's up across the board. To put this in context, for example, GT, I think based on our analysis, cash earnings was about 500 billion.
Which is something very difficult, really. Like determining cash earnings for banks.
You can't do
How
it.
do you do that?
I can give you a lecture, but this is that would be a long.
To come for that lecture.
Yeah. So I have a really good analysis
because there's got to be a crazy model for that.
That pieces this together, right? To derive. It's not 100% accurate, but usually when we speak to management and we ask them what their actual cash earnings is, it's usually quite close to what our model spits at, right? So I think if you look at GTCO, like nominal earnings was 550 billion all of last year. Already 9 months this year, they are tracking 900 billion. Right.
Nominal earnings or cash earnings?
Cash earnings. But nominal earnings is down, but cash earnings is up almost 50%.
Is that profit?
Profit. That's profit, right? So and
that's not bad considering that they're on 1 trillion already.
So the point I wanted to make is that almost 90% of the earnings that they've declared this year, right, is actually cash earnings, and that cash earnings is what is usually used to fund dividend.
Yeah,
and typically GT will pay close to 60% of its cash earnings out as dividend. So when you model that, you start looking at a business that could do 12, 13 naira of dividend in April. I don't think this is kind of in any analyst base case model, right? So, and usually the rule of thumb in Nigeria, and I think that may change as cost of capital starts to go down, is that these banks tend to trade around 10% of their dividend yield. So if you are going to pay 12 naira, 13 naira of dividend, you are looking at, on that normal high cost of capital environment, a share price of 120 to 130 naira, which it closed at 85 or 86 naira today, so that you can see what the upside is, and you can actually realize that upside quite quickly.
Yeah.
So I think cash earnings are strong. Obviously, with interest rates coming down, there's also the expectation that going into next year, earnings are going to be under pressure. I don't agree. Right?
Why?
So why your
Because
net...
you can't have both.
Let me explain. Let me explain.
Okay.
So why your net interest margin would shrink, but the pace of shrinking is a function of the asset liability structure of the individual bank. So you have to run those models, right? However, what people are not thinking about is that the cost of risk that these banks have taken over the last 2 years is super elevated. Zenith Bank, for example, has been taking close to 10% cost of repositioning, right? On a normalized basis, this should be between 50 basis points to 100 basis points, right? So to put this in context, it provisioned about 700 and something billion this year.
This year so far.
In write-off. That 700 and something billion should be between 50 to 100 billion in a recovery cycle. Usually, actually, when a bank is recovering, it likely writes back instead of takes provision, right? So you have that normalization.
But wasn't that a one-time take because of the forbearance?
It will create a base to your earnings that you can grow off. So when people are expecting that earnings come down, so this is basically 700 or 500 billion of earnings that is already baked in the core earnings of the bank that is basically going to be moved into 2026, right? So you then add on top of that, and then the other part that people are underestimating is the impact, right, of recapitalization on risk asset formation. Typically, when a bank successfully closes and does a recapitalization, it goes on an asset growth phase. And when you look at Nigeria, we are actually being set up for an improvement in the investment cycle. And part of that is the capital markets. Part of it is the loan books of the bank, basically funding capex of companies. And large capex loans, right? For example, in the oil and gas sector, you can see, right, that there are lots of conversations that will be had in oil and gas, given the number of licensing that has been happening, given the reforms in that place, given the assets that have changed. And so I actually think that on a loan growth expectation, right, relative to consensus, because consensus has been using the last 10 years to judge the growth of these banks, we were going to surprise on the upside. So in my mind, like post-democracy, right, Nigeria has had 4 economic environments. One is the Obasanjo period, right? And then you had the Jonathan, where growth was around 8.4% of GDP roughly. And then you then had Yaradua Jonathan, and growth declined to 6%. And then you had Buhari, which growth was average 3%. And now you're now back to Tinubu era, where we're at 4%. But I think that if we don't mess things up from a policy perspective, we can accelerate growth to the 6 to 8% range, at least in the very, very short term. So my point is, when you actually want to compare similar economic periods in Nigeria, you should actually be looking at that 2002, 2007 period to see how banking assets behaved, to get a sense of what is going to happen over the next 5 years. But a lot of analysts are likely going to be using the recent period of the Buhari-Murphy era to build in loan growth, to build in asset growth, to build in NIM expansion, which is why, in our view, really, and obviously cost of equity is also coming down because cost of capital is coming down. So you have this view, my view around where I think earnings are not going to come down, cost of capital is going to come down, risk asset environment is going to be strong. So
when you say risk asset environment is going to be strong, how do you mean?
So I think the loans going bad because of, we've taken aggressive provisioning. A lot of the banks, outside of a few of our friends, are outside forbearance. So the ones that didn't pay dividend, they are still in forbearance. So those ones might still be constrained. But that's also good for the ones that are outside forbearance, because those ones can grow aggressively and steal market share from those guys. Because obviously, an Access, for example, that looks to be still under forbearance because it didn't pay a dividend, right, cannot go and syndicate a $50 million or $100 million. CBN will agree.
Yeah.
Right? But a GT, a Zenith, OEMA.
So risk asset positive, basically, then.
Yeah.
So always argued that the volatility of the exchange rate is far more important than the absolute value of the exchange rate. Once the volatility of the exchange rate reduces, I don't think people care what the absolute level of the exchange rate is. That's one. The second point is we need to understand, right, that we botched to an extent the sequencing of the liberalization.
So we dodged?
We botched. We messed it up, right? When this administration took over, we had a black market clearing price of the exchange rate at 750. at that price, there was volume, and you could argue there was also premium because it's a black market. What that would normally tell you, right, is that if you had properly sequenced your exchange rate liberalization program, you probably should have ended up with equilibrium between spot and 750. Somehow, we ended up at 1.8. So we are a lot cheaper than where fundamentally we should be.
Yeah.
You've been saying that for a bit.
So even though we have seen stable exchange rates for 1.4, because I've always argued that we should try and ensure that our exchange rate, right, is cheap in real terms, which means that it should depreciate by the difference between our inflation and that of our trade partners. We've obviously had higher level of inflation relative to our trade partners. And I think the reason why we've had a bit of stability is that despite the increase in exchange rate strength in real terms, our exchange rate is still cheap.
Yeah.
Right? That is why I don't think that even at I don't want us to go back to 700. I think this competitiveness helps our export economy, and it's how we are able to potentially deal with the structural balance of payment problem that creates our persistent exchange rate crisis. So it's very important that it stays where it is. But to make the argument that the exchange rate at 1.4 is expensive, given the context of where we are coming from, it's a very hard one for me to accept.
All right, let's do a buy, sell, or hold to the audience. Buy, sell, or hold. Exchange rate at 1.4 is expensive. If you say buy. Exchange rate at 1.4 is expensive. Just raise your hand. Okay. Wow. Okay, let's go on. Do you want the exchange rate to go back to 700? Raise your hand.
Oh, wow.
So there's group therapy, there's Element House.
Element House.
Yeah.
Element House is good. Element House.
So there are few, but so I've been doing a bunch of research. I was speaking to my wife, and we're probably going to go for the next Element House, because I'm into it. I have like a bunch of playlists that I listen to, and the South African DJs are killing it. It's like Afro music with house dimension. It's a really, really good production. So that's what I'm listening to.
And what are you watching?
I have been struggling with watching lately. My wife said it's the turning 40 syndrome. So she reminded me that, remember when I was young, that when we come back home and our fathers are sleeping in the living room, and then we say, Daddy, go and sleep. So my wife thinks that's my stage of life now. Because anytime I turn on the TV, I fall asleep.
So I share a slightly different view, right? Obviously, I would caveat that we all don't have what's going to happen, right? So we're just making probability-based assessment. My starting point is, when you look at the oil market, it's been incredibly cheap for such a long time, right? If you inflation adjust $60, $65 oil, we've seen significant real deflation in oil prices. And it was only a matter of time before we got to high oil price territory. Because obviously what was keeping oil price anchored was obviously the spare capacity in the Gulf, and then obviously the shale production that was coming out of the US, and those fields were getting matured, and the incremental capital to bring up those barrels was also improving. So yes, we have seen a geopolitical risk that has jolted the oil price higher, but when you normalize $120 per barrel, $110 per barrel for other asset inflation that has happened over the last 30 years, the oil price doesn't look expensive, right? Which is why I think this might be a lot more structural than people think, and why I think the markets and the curve being significantly backward dated, which is people are expecting this to be resolved very quickly, might not actually materialize. So I do think that we have seen a step change in the pricing environment for crude. The expectation that this gets resolved and oil price normalizes back to $60 to $70 only if you are confident that we are going to have a significant level of demand shock globally would that scenario crystallize? And I actually think we might be overestimating the risk of demand shock because the energy intensity of the global economy has shifted over the last 3-4 decades. For example, the US crude oil as a proportion of its energy mix has declined to around 30% of its total energy structure. In China, which is another large consumer, crude oil as a proportion of its total energy mix is now about 18% of the total energy structure. Obviously, there are economies like Japan and South Korea that has significant level of product availability issues because they are direct suppliers from the Strait of Hormuz. But that will get substituted over time. And there's some interesting disconnect that is happening in the oil market because the market is not as globalized as people think. When you look at the Omani and you look at the Saudi crudes, they are already trading at $150 a barrel. The reason why the Atlantic Basin, which is WTI and Brent, are kind of trading a little bit more anchored is that we went into this crisis with ample inventory. And now that there is no product availability in the Gulf and the Southeast Asian companies will sweep up a lot of the inventories that are available in the Atlantic Basin, it's only a matter of time for Brent to catch up with what you are seeing in the Omani and the Gulf area. So I don't think this is a trade that is going to normalize as quickly as people think. I look at things from a relative perspective. So the cleanest dirty shirt. So when I look at Nigeria, because sometimes being local, and most locals are like this, we tend to be very pessimistic about the outlook of our country. It's just the way locals tend to behave. If you're in South Africa, the same experience. Turkey, the same experience. So when you want to look at global capital allocation, you look at the guy that is less bad, not necessarily the guy that is good. When you benchmark Africa, right, massive capital destinations on the continent, South Africa, Egypt, Morocco to an extent, and Kenya. You look at Nigeria within the context of those other countries. The others are largely energy importers that are going to have a terms of straight negative shock, right? Egypt was largely underwritten by Arab capital. And there are significant level of question marks there, which is why the currency is down 10% in very, very short order. So we need to be careful. And I know that we can have this one directional view around we need things to be good, to be optimistic. For us, we just need things not to be as bad as our neighbor. Market is a I better pass my neighbor measuring tool. So within that context, right, I think Nigeria is actually better off when I compare it to alternative sources of where to deploy capital today, right? So that's my statement. The second one that I'm worried about is there a risk that the government may impose windfall tax on the oil and gas sector given the excesses?
The macro regime that we've operated on in the last decade has been largely fiscal dominant and as such has created a huge disincentive for anybody to take risk. Yeah. There is no amount of capital technology that you would deploy that will change that.
Yes.
Obviously, the macro regime is shifting.
Yes.
We will see an increase in risk-taking as inflation normalizes and rates come down. Yeah. It is not because of capital that will change. Mm-hmm. It is that when you actually look at how returns and because of the level of fiscal dominance that we've had, it's actually been the right strategy outside of the last 2 years to have packed your money and your assets in fixed income. Mm-hmm. The capital market, the asset management industry is growing, right? Even listed CIS is over 7 trillion today. Mm-hmm. So the market is growing. It's just that the market doesn't have the vitality that we want it to do. Yeah. Some of it has to do with the macro regime. Other part of it, let's talk about the equity market today. I trade the market, and in and out transaction in the market cost me 1.5% of my capital. Mm-hmm. Right? Most of that goes in regulatory fees that I pay to SEC and stamp duty and NGX and CSCS. Right? Mm-hmm. How can I have liquidity when anytime I buy and sell a stock, I lose 1.5% of my money? Mm-hmm. Right? So, we are running this capital market like we are extracting rent, just like we are running the rest of the economy, where everybody puts their amount in the small pool that we have and keeps transaction friction. a large reason why we don't have the level of transaction intensity in this market is that the market friction is too high. That's one. Another point is there's been a lot of companies that have come to the market to list. We have this concept called listing by introduction.
Yeah.
I don't know what it is.
It's absolutely terrible.
Right?
Sorry.
Somebody comes, does the presentation at the NGX. There's no price discovery. 100% of the
floats.
asset is controlled by one
no
or
free
a close
floats.
group of people.
Yeah.
They list the business and they say they've listed. There's no requirement to go and speak to other asset managers to deepen the market, right? And then suddenly this company is listed. It's a zombie company.
But is there any law that tells you not to bring an IPO? Is there any reason why you do?
So the
issue
reason,
house?
again,
because to his point, why are your issue house bringing up
So
IPOs?
let me explain. I'll come back to that.
Yeah.
So what have we had in Nigeria over the last decade? You've had the best bank in the country trading at half its book value.
Okay.
Right? You've had Nestle, one of the best run consumer companies, trading at sub single digit PE. You've had MTN.
Nope, not Nestle.
Go and look at
Except for when they had their losses.
So
not Nestle.
let me land. Okay. So there's a huge part of the cost of equity that drives decisions for people to do IPO. So if an issuing house, no matter how much capital you have, no matter how many CFA you hire, if you come to me as an entrepreneur that is building a business largely from internal generated capital because equity is too expensive, and you come to tell me, like for example, you go to Tosin that has spent all this time building money points to the institution that it is today, and you tell Tosin that the valuation that he can get for his assets cannot be more than what GT Bank is producing, which is the best-in-class player, because that is how these things will get benchmark, right? Tosin will tell you, sorry, I will use my internal capital to continue to grow. The only time the conversation change, and no amount of valuation, no amount of CFAs, no amount of capital will change that decision function. It only makes sense.
Whose fault is that, Sam?
It is the macro situation in Nigeria that is the problem.
That is not true, Sam. The reason why your capital market, the reason why stocks, solid businesses like GT Bank have valuation multiples or earnings multiples of max 4x, 5x in this market is because all of you here, you issuing houses, don't have the liquidity to drive the market.
No, cool down. Cool down. It's a valuation problem. Issuing house don't buy stocks.
You don't buy stocks. Why don't buy stocks? Who is meant to buy the stocks?
Asset managers
That's why I asked you. So what are the issuing houses doing then?
Their job is just to bring the deal to the market.
Why are they not bringing deals to the market?
Because I just explained to you.
Why does it work now?
Let me give you a question. Hold on. Nairametrics today. Hold on. Today, you own Nairametrics, and I tell you that I want to bring Nairametrics to the market, right?
Yes.
Nairametrics, you don't have buildings, you don't have printers, you're an online business.
Printers, though.
What am I paying for? I'm paying for your intellectual. What? I'm paying for your mind. That's what I'm paying for, right? So I can value Godre's business now at 100 billion.
Yeah.
But I cannot put assets to the extent that I can value. Oh, that's maybe asset is 2 billion, right? So that's the same thing.
You're missing the point.
No, an issuing house is just me. It's just Dele coming to Godre to say, Godre, I want to list your business. And you say, I look at your business and I say, you know what? This is how we can list the business. This is how I can market it. That is my job. That job is intellectual.
How is it that?
That job is intellectual. Why do I need capital? Why do I need capital to do that?
I want to tackle that.
How is that an issue?
How is it that in this same market, in 2006-07, we had all sorts of companies list on the exchange.
You just answered my
valuations that are multiple.
You just answered my question.
It wasn't like the macros were so great.
It was.
As much as it was good. But no.
It's not just macros, it's cost of equity. See, for example, if you come and meet
guys, Sam, let me land. You answer. Wait. There are a lot of people today with cash. There's a lot of people today with cash sitting on the sidelines. Arnold. They have cash. We just said they're 140 trillion sitting on the sidelines.
Not deployed.
They don't want to get into the stock market because
they feel like they can't trust brokers and everything that happened because of this car of 2007 and 8. That is the problem. And the capital market operators of today haven't done anything to solve that problem.
What does capital solve? How do you solve that with capital?
I don't care. Whatever it is that needs to happen to solve it, because without demand, you're not going to see that liquidity.
I think we are having a definition problem. Capital market operators are intermediaries.
Yeah.
They are not ultimate risk takers.
Exactly.
No, I'm not talking about risk taking.
No.
Because
let me finish. They are intermediaries. If you don't have a value to intermediate, you can have all the CFAs
in the world.
You can have all the capital in the world. There will be no value to intermediate. So, for example, if you come to me, the reason why people were listing in 2006, 2007 is that I know that if I sell 5% of my company, I can invest in that plant that will create value more than the 5% that I've given away.
Because share prices were high.
So that is why the cost of
There's
capital.
a demand problem you're not talking about here.
See, it's a cost of capital thing. I'll explain why it's a cost of capital thing.
Who the hell is talking about cost of capital? It's a demand issue.
Can I ask you one
Demand is
question?
reflected. Let me finish. Demand is reflected in your cost of capital. And I will explain. This same market, right, that we think like it's a dead market.
Yeah.
It's the same market that Okomu went from 30 Naira to 1,006.
Thank you.
It's the same market that
But 1 year that
NASCO
raised to
went
50 billion.
from penny stock to 100 Naira stock. So the point is, markets, right, no matter how much you try and say is innovation, is this, what drives value in a stock market anywhere in the world is growth and return on invested capital. Nigeria has not delivered growth or return on invested capital over the last decade. So it is wishful thinking to think that people will just come and be buying stocks for that reason alone.